Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's ABSA.
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
How was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's ABSA.
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
How was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's ABSA.
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
How was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's ABSA.
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
Hey.
How was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's ABSA.
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please. Please make those payments and take dinner out the freezer. Enjoy your day off.
Who's Abby?
Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. Enjoy your day off. Please make those payments and take dinner out the freezer. En
Hey,
How was your day?
great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's ABSA.
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Good morning, ladies and gentlemen. I'm expecting a response. My name is Helen Nangonzi, and I'm the Marketing and Customer Experience Director at ABSA. Thank you for honoring our invitation and joining us for breakfast this morning. That's one of the main agendas. I'm sure all of you have had something to eat, which is good. The agenda this morning is going to be very enriching. We're going to be unveiling our Africa Financial Markets Index report and going into an in-depth for the Uganda chapter, after which we'll also have the economic outlook for 2022 shared. My role this morning is just to be your MC. We'll start off the program with a few speeches, and then after which we'll go into a panel discussion. I'll introduce the moderator at that time. And for now, please allow me to invite our CEO and Managing Director, Mumba Kalifungwa, to welcome us and make his remarks. Mumba, you're welcome.
Good morning, ladies and gentlemen. First of all, our sincere apologies for starting the program a few minutes late. We are expecting one of our distinguished guests, who's the Permanent Secretary to the Treasury. Unfortunately, he has been held up due to some other commitments, so we have elected to commence with the program. And should he come in, we will accordingly accommodate him space to address us. With that said, I'd like to begin by acknowledging the presence of the Deputy Governor of the Bank of Uganda, Dr. Michael Atingi Ego, our esteemed guests and customers, members of the ABSA Uganda Country Management Committee, must I say distinguished guests, ladies and gentlemen. We pause a minute. PSST has just walked in so that he can settle down. Welcome, PSST. I was just opening and apologizing for the late start due to the pressures that you had to deal with before you got here. And just as I was finishing, you came through. So it made a nice intro for my speech. Thank you very much for gracing us with your presence. So I'll start again. Ladies and gentlemen, thank you very much once again. PSST, we welcome you and thank you for gracing our occasion this morning at this important event that speaks to the economic outlook for Uganda and also gives an update in terms of our appraisal as a group of the financial markets of Uganda and how attractive they are to foreign investors. So distinguished guests, Thank you once again for joining us as we present and deliberate the findings of the 2021 ABSA Africa Financial Markets Index. This index is released annually and facilitates meaningful debate about the maturity and accessibility of Africa's financial markets. And it records the openness to bring foreign investment to countries across the continent. The report assesses progress and potential across 6 pillars, namely market depth, access to foreign exchange, market transparency, the capacity of local investors, macroeconomic opportunity, and the legality and enforceability of standard financial markets master agreements. It is a report that is produced in collaboration with the Official Monetary and Financial Institutions Forum. The index is a credible source of information and insights on financial markets across Africa and macroeconomic indicators, providing vital data for the business community, policymakers, economists, regulators, and the various players in the market. For the 5th year running, we have hosted an economic forum to present the findings of the report and also facilitate meaningful deliberations with key players from government, the private sector, and business community, focused on strengthening our financial markets. We believe that it is not only imperative to present the index, but importantly, pursue a collaborative approach to improve Uganda's ranking and foster economic growth across key parameters. I would therefore like to appreciate our policymakers, regulators, and market practitioners whose input through various consultations was essential to the findings presented under the index, some of whom include the Bank of Uganda, Capital Markets Authority, of course the Ministry of Finance, and Uganda Securities and Exchange Commission. These entities continue to play a key role in developing Uganda's financial markets. This year, once again, we are grateful to have the Ministry of Finance, Planning and Economic Development, and the Bank of Uganda as partners for today's deliberations. Today, we will discuss the report and have a collaborative discussion on the role that various key players can play in creating a favorable environment for sustainable economic growth. The aim is not just to present positions, but also show how economies can improve market frameworks to meet yardsticks for investor access and sustainable growth. As we delve deeper into the report findings and macroeconomic indicators, we will assess the performance of the economy and what needs to be done for further growth. I would like to extend a warm welcome and my appreciation to our speakers and panelists for honoring our invitation to grace this event. I look forward to positive deliberations as we work together to create a favorable environment that will enable sustainable economic growth for our beloved country. With those few remarks, ladies and gentlemen, I would like to take this opportunity to welcome our distinguished guest, Dr. Michael Atingi Ego, the Deputy Governor, Bank of Uganda, to give his remarks. I thank you.
Mr. Ramadan Gobi, the PSST, Minister of Finance, Planning and Economic Development. Mrs. Nadine Bierugaba, the Chair of the Board, ABSA, Bank Uganda. Mr. Mumba Kalifungwa, the Managing Director of the ABSA, Bank Uganda. Representatives of the Official Monetary and Financial Institutions Forum, moderators, presenters, panelists, ladies and gentlemen, a very good morning to all of you. I'm very pleased to address the ABSA Bank Uganda Economic Outlook Forum and the launch of the 2021 Africa Financial Market Index, AFMI. Thanks to Mr. Kalifungwa, not only for inviting me to participate in this year's edition of the forum and the AFMI launch, but most especially for postponing the event from January to date, out of respect for our departed gallant governor, the late Professor Emmanuel Tumusiime Mutebile. The board, management, and the staff of Bank of Uganda appreciate everyone who joined us in the mourning and the funeral of our dearly departed former governor. By advocating and leading the liberalization of the Uganda's economy during the decade of the 1990s, against a determined opposition from those who preferred a command economy, the late Professor Tumusiime Mutebile was the foremost promoter of the 6 pillars of the AFMI. I hope we'll not let go this legacy. He championed the creed and policies that underpinned Uganda's performance in the AFMI as if they were articles of faith. In the words of Professor Sir Paul Collier, who eulogized the late Professor Tumusiime Mutebile in the Financial Times newspaper, he said, I quote, "As a rare man of greatness, he is irreplaceable," unquote. May his soul rest in eternal peace. Ladies and gentlemen, hearty thanks to you for patiently waiting for this event. And as they say, all good things come to those who wait. One of the best things that have happened to Uganda during the pandemic times has been the jump in the ranking to come first in East Africa and 5th in the latest AFMI of 2021 from the 10th previous position. This inspirational ranking amidst the raging COVID-19 pandemic should galvanize us to sustain the good policies and interventions, as well as to undertake the strategies that will unleash the power of our financial markets to drive economic growth and socio-economic transformation. I'm happy that my good friend here, Mr. Ramathan Ngobi, the PSST, at the ministry, is present. Together, we are determined to work with all the stakeholders to ensure that we consolidate and improve Uganda's commendable ranking in the AFMI for 2021. We must prove that the jump in the ranking was not a mere fluke by holding our ground and advancing towards the top. Targeting the top of the index is symbolic of our determination to nudge, push, and incentivize the fuller development of our financial markets. Effective and efficient financial markets in an open, transparent, and progressive economic environment will sustain and broaden our capacity to attract global capital, promote the effectiveness in the use of domestic resources, increase resilience to economic shocks, and stimulate economic recovery that remains fragile, partly due to subdued investment. The posting of outstanding performance during a stifling pandemic reveals that Uganda has the potential to do better with significant opportunities ahead of us. Further improvement in the business environment, as measured by the index, will enhance foreign and domestic investor confidence by reducing the uncertainty associated with frontier markets. So therefore, sustaining and improving good performance will assure the world that Uganda is open for business in foul and fair weather. Given that we know where we want to go from here, that is the top of the index, the question is, how do we get there? And this is where AFMI proves its most potency. By applying common metrics across peer economies and evolving with emerging issues, the AFMI shows us where we do well, as well where the challenges that hold us back from doing better. The index clearly shows that we must do more to attract the global capital and incentivize the optimal deployment of domestic capital through sound financial markets. At this point, allow me to pose a challenge to ABSA and OMFIF, that is, OMFIF, I'm told, is the organization for what? The Official Monetary and Financial Institution Forum, to ensure that the methodology underlying the index is robust and is always credible, especially during the inclusion of emerging issues that are critical to financial flows among countries with diverse financial infrastructure and macroeconomic policy frameworks. With this great power of establishing a respected benchmark comes the massive responsibility of guaranteeing the inviolable reliability and integrity. We should take lessons and avoid the fate of the erstwhile iconic Doing Business Index of the World Bank that had gained currency across the world. Ladies and gentlemen, by now, you'll be aware that Uganda was one of the 4 countries that posted improved scores and one of the 2 countries with improved scores above 50%. The Bank of Uganda, working with stakeholders, enforced a standard master agreements, i.e., the Global Master Repurchase Agreement for horizontal repos, swaps and derivatives, master agreements, and securities lending master agreements. The primary dealer reforms aligned our financial markets with international best practices, putting Uganda in a small class of African countries with a true primary dealership system. Consequently, the liquidity in the secondary market of government securities, as measured by the number of transactions relative to the primary issuance, rose from 54% during the pre-reform days in the year to October 2020 to 150% the year ended in October 2021. This is no mean achievement. And like the late governor would say, that deserves Obugalo. The securities are now tradable online on international platforms such as the Bloomberg and the Refinitiv. The transactions traded on these automated platforms are about 20% of the total secondary market transactions. That's a big achievement. We now aim at achieving the global visibility of Uganda government securities through listings on the frontier and emerging market indices, including the Bloomberg African Bond Indices, what is commonly known as the ABABI of the African Development Bank, the FTSE Frontier Market Index, and the JP Morgan Emerging Market Index, among others. Interbank lending and borrowing through horizontal repos is now backed by government securities as a collateral, and soon market participants will be able to undertake securities lending as well. Efforts are underway to link the Bank of Uganda's Central Securities Depository with the Uganda Securities Exchange Central Depository to facilitate retail trading of government securities. With the backing of our prime partners at the Ministry of Finance, Planning and Economic Development, the Bank of Uganda will democratize the trading of government securities on mobile phones through the project Okusevinga. This one is taking the purchase of government security to the very bottom of the pyramid in our society. This initiative will facilitate broad-based retail investment in government securities, thereby promoting the optimal deployment of domestic savings and hopefully reducing the high yields that reflect dominance by the traditional players. Building on our established strength in the AFMI, the national foreign exchange reserves grew by 13.1% during 2021 to ensure that we maintain the reserve adequacy that gives confidence to foreign investors, among others. You might ask, how did we grow these reserves by 13.1%? As a result of the significant inflows on account of the offshore players participating in our government securities, which would have strongly appreciated the currency, Bank of Uganda, in minimizing volatility in the exchange rate, was purchasing that, some of these excess reserves that would have caused volatility without trying to reverse the trend. As a result, we were able to increase our reserve coverage by 13.1%, thanks to all the things that we're doing under the AFMI. Also, we see that the forex market turnover grew by nearly 20% to $24.5 billion, and the lending in the swap market increased by nearly 130% to 113 trillion Ugandan shillings. That is in the swap market. So the banking system has weathered the COVID-19 storm well so far, with the Bank of Uganda monetary and financial sector policies and interventions, including the accommodative monetary policy, unprecedented liquidity support for the supervised financial institutions, as well as the credit relief measures helping to shelter the financial system and prop up economic activity. The Bank of Uganda commenced the implementation of Basel II banking regulations for the banking supervision to enhance financial and operational risk management, among others. We also reduced the reliance on check payments to advance the e-payment platform and advance the implementation of the National Payment Systems Act, including the use of the regulatory sandboxes framework for safe testing of innovations before full deployment, and concerted efforts are now underway to develop a national payment switch to aid interoperability and reduce costs of financial transactions, among others. Going forward, Uganda will improve its ranking by fully exploiting the potential of the pension sector to boost and optimally deploy domestic savings and harness technology to extend financial services to all corners and members of our society. The inclusion of emerging issues in the sustainability presents another crucial opportunity for Uganda to improve its ranking in future, especially as the country embarks on the development of its oil sector. We must manage environmental and social risks associated with the exploitation of the oil and the gas resources to uplift our people from the clutches of grinding poverty. We may not, of course, have the privilege of leaving our oil in the ground in preference for purely green financing like solar and wind alone, because development requires scaling up of energy usage for industrialization. Nevertheless, we must ensure sustainability by managing the risks, principally by protecting the environment and restoring it to its natural form post-oil era. It's also vital to ensure that communities that are directly affected by the development of the oil industry are compensated, including appropriately. On our part, Bank of Uganda is also considering the management and the integration of climate risks into its policy framework and across its operations, as well as working with all the stakeholders towards the establishment of a sustainable financial system that takes into account all the, the issues that may contaminate the environment. The bank and the Ministry of Finance are exploring further reforms and initiatives to enhance financial market development, but allow me abstract from the specific details, not least because of the need to heed to the wisdom of Prince Bismarck, who remarked that, quote, to retain respect for the sausages and laws, one must not watch them in the making, unquote. I hope we can delegate the kitchen work to a technical working group to harness the AFMI 2021 by studying further, designing and overseeing a roadmap for addressing the challenges that were identified by the index and thereby pushing to the top of the ranking in the future. Now, ladies and gentlemen, let me conclude by thanking ABSA and the official Monetary and Financial Institutions Forum for building and establishing this great benchmark for motivating the development of African financial markets, thereby helping to diminish the risk premium associated with investing in our continent. I thank you all for listening to me, and I look forward to learning from the presentations and the panelists today. Thank you very much, and you all keep safe.
Another round of applause for the Deputy Governor. Mumba, I thought we had a deal, but I'll invite you back. So Mumba, this is to request you to come and invite the PSST. Thank you.
Thank you very much, Deputy Governor, for those enriching remarks. And we do take heed in all the counsel that you have offered to the ABSA group and the research team of how we maintain credibility of this index going forward, because I do believe that's a very important aspect of ensuring the relevance of this particular tool. So we thank you for your remarks. At this point, ladies and gentlemen, it's my distinguished honor and pleasure to call upon our Permanent Secretary to the Treasury, Mr. Ramathan Gubi, to come and give his remarks. PS.
I didn't know that this disease of protocols and bureaucracy has also entered the private sector. The Deputy Governor, Bank of Uganda, my good friend Dr. Mike Atingego. Let me remove also this one, since you were telling us COVID has gone, but it is still around. Be careful. Any senior government officials who are present, the chairman of ABSA Bank, the MD and your team, all of the panelists today, and the presenters, distinguished ladies and gentlemen, good morning to you all, and I'm glad to be here with you. I would like to begin by thanking ABSA for undertaking and sustaining this index. I vividly remember the inaugural ABSA Africa Financial Markets Index in 2017, which I participated in, and Uganda then ranked 10th, in the middle position there, both actually indices of 2017 and 2018, scoring on both occasions 50%. Again, the middle score. I remember On pillar 1 of market depth, we scored 43% in 2018. Now we have scored 45% last year. Very, very slight improvement. We need to work harder at that front. On pillar 2 of access to foreign exchange, we scored very well, 83%. But now we have degenerated to 61%. In pillar 3, market transparency, tax and regulatory environment, we scored 60% in 2018. We have maintained the same score. In pillar 4, capacity of local investors, which is my dear pillar at the ministry, we scored 13% in 2018. We have now scored 16%. I used to be a teacher a few months ago. This is not only a retake, but a very bad one. On pillar 5, macroeconomic opportunity, we scored 63% 5 years ago. Now we have scored 70%, some improvement. And lastly, on pillar 6, enforceability of standard master agreements, we scored 33% in 2008. We are, 18. Now we have scored 90%. So congratulations to Bank of Uganda. So as a result, Uganda has improved generally. As the Deputy Governor has told us, we have improved our ranking by 5 places, and that's overall, and becoming the first now in terms of financial market depth in East Africa. I am told, and we can also see from the scores I've read, that this has been on account of mainly 2 areas, or 3 of them. That one of Michael, effective enforcement of our standard master agreements, as well as interbank bilateral agreements, and also enactment of Payment Systems Act and the reforms in primary dealership, which also we have seen in the recent past. Ladies and gentlemen, the depth and the liquidity of capital markets, as we all know, is fundamental to supporting economic growth, creating domestic investment opportunities, and attracting foreign and local capital. The presence and size of corporate bond market increases product diversity from government bonds, which now we are traditionally used to here, and also from those short-term treasury bills, which as a percentage of local currency debt makes it harder to build a broader, having some level of employment, and so on and so forth. And to move Uganda from this predominantly agrarian, informal SME economy of non-tradables, we are committed to doing a few things. Number 1, building the capital markets, to offer longer-term debt and equity financing to our businesses, particularly SMEs. Number 2, attracting venture capitalists who accept higher risks and don't require collateral, and also have the ability to build the capacity of the businesses. And 3, building SME-focused stock exchange, given that SMEs don't meet the listing criteria for the conventional stock exchange. Our commitment, therefore, is, number one, to keep the achievements we've had and we've seen ABSA recognizing in this index in sight, and also consolidate them. But two, embark on further reforms, such as those which the Deputy Governor has mentioned. We would want, and we have had conversations over this with the bank and other stakeholders. How do we diversify the area of financing? The Deputy Governor has emphasized the aspect of the climate financing. Now we have what we call green bonds in some countries, which could raise money for those clean investments through attraction of investors who are climate finance oriented. How do we explore this? He assured us that the kitchen will be occupied by people who can do this job. Diaspora bonds also need to start thinking about these. How do we get our relatives who are sweeping out there in the diaspora to invest in another way, you know? Yeah, I have some relatives sweeping in Canada, in the UK, in the Emirates. When they send their money here, some of our relatives divert the money. They take pictures of neighbors to send them. So, how do we help them? By also helping ourselves to access this financing. We have also pension reforms the Deputy Governor has talked about, which are intended to deepen our financial sector. We have talked about this for a long time. We need to finalize the cooking and be able to implement them. And also review the investment mixes of those pension funds which we already have, so that we can explore more liquid areas and the other developmental oriented areas, as well as rationalizing the tax system. The tax system. I've been told there are areas we can take advantage of, looking at, for example, the mix of our, say, withholding tax on equities. Can we try to look at how we can rationalize that? I'm very much open and shall be part of that kitchen. I would want also to briefly talk about our economic strategy. We have three major objectives in our strategy of next financial year and the medium term. During next year, 2022-23, and also over the medium term, our economic policy will seek to achieve these three objectives. Number one is the mitigation against COVID. Because COVID is still with us, we need to mitigate its impact on people's lives, but most important also, now that we are no longer dying a lot, how would we also save the businesses? So the impact on business activity and livelihoods of the COVID-19, we are going to be focusing on that. And in the toolbox, the first area is to ensure that we vaccinate Ugandans. I think we are now comfortable, relatively comfortable, to remove a mask. I can see in the room there are few people who are keeping the mask. We have declared ourselves free mainly because of the vaccination. It's the game changer. So if we could vaccinate a big proportion of Ugandans to achieve that so-called herd immunity, we hope that will keep the economy fully open and we don't go back to any lockdown. So we are working on that, on ensuring that we deploy vaccines to all Ugandans who are willing to take one, and incentivize those who are not willing. Because even there are people you will find smoking, you tell them smoking is dangerous, and they are very well educated professors, but they are looking at the packet, of cigarettes. That is a very strong word. Cigarette smoking is harmful to your health. It causes lung cancer and death. And the prof is, puffing away as he's reading that. Not because he's ignorant, no, but he needs help. So there are those who need help to understand the significance of vaccination, and we shall do that. Plus also the financial support to businesses where possible to access some recovery funds to kind of strengthen their balance sheets a bit, their cash flows, and we have overspoken on this one. You know it very well. And we know we can't do much as government without the partnership or involvement of the private sector, particularly our financial sector. The second objective is to speed up socio-economic transformation. We are focusing on that. How do we speed up the transformation of Uganda? When we say these words, sometimes they just sound words, English words. Socio-economic transformation. The Ugandan economy we often discuss in these very well decorated rooms, well lit, air conditioned, is a very, very narrow economy. Millions of Ugandans out there, they don't know that actually this world exists. They're in their own world. UBOS tells us about 3.5 million people. They work for just surviving. They grow potatoes, they eat them, they sleep. They wake up, they go to church. They grow more potatoes, they sleep, We need to bring them into the economy, to start looking at life the way we look at it, in a pecuniary manner. And that's what socio-economic transformation is all about. We are doing this by, number one, reprioritizing our national budget so that it can redirect resources towards wealth and job creation. And also deepening industrialization. For the first time, Uganda crossed the 10% value add on manufacturing in 2015. In the history of Uganda, to get to 10% and you cross that line. Currently, manufacturing is contributing about 15% of our GDP. But that is very, very small. And when it comes to employment, it is less than 5%. You can't transform a country of peasant farmers and producers of food. Food has low income elasticity of demand. As people's incomes rise, they don't eat more food. No. The food I used to eat when I was teaching my students is what I eat when I'm Secretary of the Treasury. Now I don't eat a sack of rice. No. But there are certain things which I've increased in consumption. I've bought more neckties and suits and shoes. I used to hate these things. Now I put them on daily. So who's taking advantage of me is the manufacturer and the service provider, like a Mumba. We open more accounts, dollar account, this account. The farmers of tea, I'm going to put only one tea bag in the cup, the one which I put before. I will not put in 4 now. So the income elasticity of demand for food producers is almost 0. So to take advantage of the global economy, as Uganda, we must industrialize. And that's why our strategy in the medium term is to see how we accelerate this. Export promotion is another area, as well as other areas with high return on investment. The third and last major objective is sustaining stability, both security and macroeconomic stability. These are the key foundations for recovery, growth, and transformation. You know, I hear sometimes some people say, you are spending a lot of money in certain areas. Reduce and put it here. If you don't spend it there, you might not be able to do what you want, the other thing you want to do. So next financial year and the medium term, we are going to vaccinate Ugandans. We are going to stimulate businesses. We are going to invest more in industrialization, especially agro-industrialization, light manufacturing, as well as industrial park infrastructure. We are going to also support the COVID-19 emerging investment opportunities, especially in export promotion and import substitution areas. We are already supporting within government digitization. We are automating government and also would want to see the same acceleration by supporting the private sector, as well as scientific innovations, including protection of intellectual property. We are also looking at market entry. We want to support more market entry as opposed to just market access. We have negotiated a lot of market protocols, but our private sector is finding it difficult to enter them in the UAE, in the EU, and in the newly created African Continental Free Trade Area. We are continuing with infrastructure development, but now by mainly looking at maintenance, road maintenance, energy reliability and affordability, rail rehabilitation, and urban transport. We are also commercializing our oil and gas, since now we have the FID, as well as mineral beneficiation. We want to restore tourism and hospitality sector by supporting the rebranding of Ugandans to get more tourists, especially now that they're emerging from this difficult situation. People want to find places where they can really cool off and get the stress and the depression of local downs. We would want Uganda to be one of those destinations. So we are working with the fraternity of hospitality sector, especially our tourism authorities, to support the rebranding of Uganda. Deepening financial inclusion is also an area we are looking at in the next financial year and in the medium term. We are implementing our parish development model to support those Ugandans I've told you to join us. I know some of us in these rooms, we usually have reservations on investments which do not directly impact us. But if an investment is not towards your cohort, You comment in a reserved manner. Leave those who are the direct beneficiaries to be the experts, at least. Because these Ugandans also need to really join us, those who are in subsistence. We are also embarking on a number of public sector reforms to achieve more efficiency and effectiveness by rationalizing government. Next year you will see a number of government agencies and departments rationalized. And also embarking on e-government, particularly e-procurement and e-education. To finance these ambitious strategies, we are going to implement some practical actions under our domestic revenue mobilization strategy to generate more revenue. We have done a series of studies. We have finalized them. There are a number of measures my minister will tell you that we are going to undertake. But this, we are very mindful of also the challenges the private sector has faced in recent times. So we don't intend to introduce new taxes or increase the current rates, but we will enforce more enforcement. Compliance is needed now. We are also going to get more people into the tax bracket. Those are the reforms we are mainly looking at. We want also to enhance the management of public debt in line with our new charter for fiscal responsibility to ensure that our national debt stays sustainable. We are going to borrow largely concessional or longer term dated, commercial, to reduce our refinancing risk. We are reviewing some projects to identify those which are poorly performing so that they can be improved or renegotiated or cancelled if there is no chance of them to perform in the short term. The intention here is to release some space, to free some space, fiscal space, so that we can get resources for those ideas I've mentioned. I am therefore optimistic, ladies and gentlemen, about Uganda's recovery. We are very optimistic. We have a clear plan and a path to fully recover the economy. And I am confident that we are going to emerge out of this pandemic stronger, and with the reforms we have embarked on, we are going to prosper within the medium term. We are also finalizing the preparation of our new financing strategy for the country, especially for public investments. We want to diversify our financing options and address constraints to access to financing by both private and public sectors. We have identified 5 related challenges to public financing that end up impacting private sector investments as well. And these are: number 1, misalignment of public and private investments to appropriate financing. For example, we have a challenge of short-term financing for longer-term investment. We want to address this. Secondly, the lack of diversification of financing options. We are into a very narrow play book of debt and taxes. We would want to explore those things which the Deputy Governor has been talking about and I have emphasized. Number 3, inadequate financing to implement priority projects. It's also a very big challenge. So we have ended up into what we call budget tokenism, giving every project small money. And that's why, partly, why some of them delay. The fourth one is insufficient private sector involvement in public investments. And the last one is poor sequencing of acquired loan financing, leading to delayed disbursements and also completion of projects. We have developed a strategy to address these by exploring all relevant sources of financing, domestic, external, and emerging financing sources. We shall publish this strategy very soon after undergoing the necessary approvals. And we shall look forward to engagement. We are going to, we call it validate. We're going to validate this strategy with the private sector, with our partners, to see how best we can improve the performance of our financing portfolios in the country. In conclusion, ladies and gentlemen, the past 2 years undoubtedly have been a pain to each of us. But to me, and given what ABSA is telling us here, the future looks bright. I've, however, noticed anxiety among some people about recent spikes in prices. I thought the man who's more knowledgeable about these things will comment. There are recent spikes in prices of fuel, of soap, of cooking oil, and a few other specific items. The rise in these prices is a temporary shock, and more so an external shock, having been caused by disruptions in the global supply chains by COVID-19, as well as now the geopolitics we are seeing in different parts of the world. This situation will normalize, and very soon we shall see some of these spikes peak and get down. I request you as a country to support the reforms that we've proposed so that we can create an economy that works for everyone, not only for a few people in the greater Kampala metropolitan area. We want a Ugandan economy for all Ugandans. I thank you.
Another round of applause for the PS. It's now time for us to delve deeper into the report. And to do that, please allow me to invite our group chief economist and also the head of macro and fixed income research, Jeff Gable. Give him a round of applause. It's going to be a tag team between him and David Wandera. David Wandera is an executive director and also the head of financial markets. So David, you're also welcome to the stage.
I think David will join. We're going to hand off to one another.
All right, I'll leave it to you.
Thank you very much. It's such a privilege to be able to walk up here on the stage, take a mask off, and see people in person. It's been more than 2 years since I've been able to visit Kampala. My first visit here was 17 years ago. And so it feels like I've been away for a very long time. I was fortunate enough, I took the opportunity. I arrived quite late yesterday evening. So instead of taking the expressway, I took the Entebbe Road all the way in. And what a treat to see just how much things have changed just in those 2 years. My name is Jeff Gable. As introduced, I'm the chief economist for ABSA. In the role I'm going to play right now on the stage, it's about really introducing some of the detail of the ABSA Africa Financial Markets Index. There are a number of familiar faces in the audience, and it's so heartening to see people that have been with us in this journey over the last 5 years. It's heartening to be here at a time when Uganda's score, as we've heard already from the Deputy Governor, is on the rise. And it's fascinating to be here at a time, as we've heard from the Permanent Secretary, where there's a real focus on sort of finding ways to diversify financing to ensure that not just foreign money, but diaspora money, money in the country is put to use in the most effective way. Because that's really at the core of what the African Financial Markets Index is trying to do. It's about attracting global capital, but also about ensuring that domestic capital, the stuff that's either in pension funds or under the mattresses, that capital's put to its best use as well. And around that, you'll know from previous years, our focus is really around encouraging financial market developments for financial markets that are open and transparent and accessible. And then the index in that space, ABSA with its partners OMFIF, is about providing the information necessary, we think, to make progress on that side. It's about debate and learning. It's about having the information at our fingertips. It's about active discussions around what's there and how things can be improved. As you know, there's 23 countries in the index. We capture not the lion's share of countries across the continent, but those 23 reflect more than 80% of the continent's GDP, more than 2/3 of the population. And certainly we're in active discussions with OMFIF to increase the coverage further. From East Africa, you will know it's not just Uganda and Tanzania and Kenya. Rwanda and Ethiopia are in the index as well. So if one's looking for opportunities for regional rivalry, we certainly provide it each time we launch. The first thing I want to mention here, and I don't know, is there a PowerPoint up and running? Let me just see here if that's, am I working this correctly? There we go. So the first thing I want to mention is just some of the qualitative aspects that I think make the report really valuable. So first and foremost, despite all of the challenges that all countries across the continent have faced during the last 2 years, during the strain of COVID, what we see across all index countries is a further focus on sort of opening, making their markets more transparent and more accessible. So in things like early market development in Lesotho, the very first company has been listed on the stock exchange. In East Africa and Ethiopia, we're getting just that much closer to opening up an equity market. It's about facilitating retail investment. So in Malawi, they've introduced a WhatsApp facility so retail investors can go and find out how to invest. And if they decide they'd like to, an easy way to find basic information, financial information on companies. And here in Uganda, of course, there's already progress between linking the securities depository information from the Bank of Uganda with the stock exchange. But we've heard about the efforts from the Deputy Governor about making retail investment into the bond market easier going forward. And there's been a focus on long-term financing as well. Kenya issued a 21-year infrastructure bond, more than $750 million. Tanzania, also here in the region, extending its domestic yield curve out to more than 25 years. So there's an awful lot going on, even in this more difficult environment. The second thing that we've really been focused on is around sort of digital innovation. So on the digital innovation side, we've got sort of digitalization of exchanges and making it easier and cheaper for investments. We're talking about those opportunities I've just mentioned too a moment ago, about making it easier for retail investment into the markets, to bring that money out of the mattress and get it put in productive use with higher return into the economy. It's about regulatory sandboxes. That's thinking about all this new fintech revolution, and getting regulators together to understand how these things were into play and make sure we don't break it before we start. And of course, there's also discussion in many parts of the world, and here on the continent as well, about things like central bank digital currencies. And so we saw late last year, Nigeria launched the e-Naira to a lot of fanfare. Now, one of the things, and we heard the Permanent Secretary touched upon this. The focus on sustainable financing in ESG and others. For those who might remember, when we launched the previous year's index, there was a box on ESG, where we were looking to talk about what's being done in different countries as examples. As we often do with the index, new ideas start as a box in one year and then end up as part of the formal scoring in the subsequent year. And certainly that's been true for ESG. So for this 5th edition of the index, we've started talking about sustainable finance as part of the formal scoring. And so in the first pillar, it's about the availability of products. That's green equities, it's green bonds, opportunities for sustainable finance. And there you'll see of the 5 things that we measure, Kenya is leading the way in that space. Mauritius and Morocco sort of in close pursuit. No score yet. When we look to measure this at our data edge, no score yet for Uganda in that pillar on this measure. But certainly from the things I've heard here already this morning, it looks like solid progress is being made. And in the 3rd pillar, we look to measure the regulatory environment, whether there's regulation that provides for, encourages the issuance of sustainability-linked issuance, whether financial accounting, you encourage sort of thinking about sustainability in that space, and a score just for environmental accounting as well. So across that, of the 23 countries in the index, only 13 of the 23 scored more than the bare minimum. The practical implication of that is we've included new measures that many countries don't do very well on. Overall scores, as a consequence, have come down a little bit. Against that, with the sorts of efforts that countries are making to align their priorities with the ESG priorities that we see globally, certainly there's an expectation that this low-hanging fruit will ripen in the next edition, in the edition after that, and we'll see scores start to rise again. The index itself is across those 6 pillars, as we've heard already. And the reason why we have so much stuff in here, there's more than 40 things we measure, organized around the depths of markets, how easy it is to get information and how easy it is to get foreign exchange itself, around the regulatory environment, the strength of local investors, the macro environment, and some global agreements. The reason we have all those things in there is because measuring the openness and transparency and accessibility of financial markets is no easy thing. And it's going to mean different things for different parts of the market. The great news in this space, right, is there isn't any one particular indicator or measure that will really drive a country's score. Against that, what we have here is a huge breadth of information where, again, we can generate discussion and learning and take a way forward for ourselves as a continent. The measures themselves, if you're interested in more detail, in the print copy of the index, sort of the inside back cover, pages 42 and 43, include more detail on how we measure the various stuff. I should also mention, because I know that there's always, maybe not a concern, but there's always an appropriate high focus on the quality of the data. It's particularly poignant in countries if the score has fallen in a particular year. People tend to question the scores less when they're on the way up. But what we do in that space is we tend to get quite a lot of data from publicly available sources. We look to get data where one data source has data across all the countries on a comparable basis. We have, through OMFIF, the interactions with more than 50 individuals and organizations across the continent. It's not just the data, but it's qualitative discussions as well. And each year, with our partners OMFIF, certainly we're looking to improve sort of the breadth of coverage and the quality of coverage as well. But I'm aware that I've been speaking for quite a while already, and we haven't got to the scores yet. Now, happily, for those of you who are listening closely, the Deputy Governor already highlighted that Uganda moved up 5 places this year, from 10th to 5th overall in the index. That is a fabulous outcome. There's still more work that can be done, but really quite a fabulous outcome. The top 3 places in the index, unchanged this year. South Africa taking top spot, followed by Mauritius, its second year in second place. Nigeria, similarly, its second year in the top 3. Within that space, though, the typical message that we've had over the 5 years is that more countries than not have increased their score, and it's about who's increasing fastest moves further up on the table. This issue of the African Financial Markets Index is a little bit different, in part because of the inclusion of ESG, in part because of some other methodological changes we've made, in part because of the strains of COVID. 19 of the 23 countries actually saw their scores fall, including all 3 of the top 3 countries. So in some sense, this is a period where places like Uganda, where the score is improving, for once the goalposts aren't getting further away, the goalposts are getting a little bit closer. As I said, Uganda is one of the standout performances. Improving score, one of only 4 countries that did, moving up 5 places in that space, an absolutely superb outcome. David's going to discuss Uganda's score in a little bit more detail now that will give you a flavor of what drives that, and then I know for the further discussion, we have an extensive panel that will be able to offer insight and debate. But for now, thank you very much. I look forward to engaging further a little bit later.
Thank you, Jeff. Ladies and gentlemen, all protocol observed, it's my absolute honor to be standing before you. First time in 2 years, 3 years. Well, last did this, I think, in 2019. So it's my pleasure, absolute pleasure. I know we're behind time, so I'm going to try and make quick work of this. The good thing is that the Deputy Governor made my work quite easy because he actually went through and analyzed a number of the pillars. Like Jeff said, there are 6 pillars, and I'm going to go through them briefly just to highlight how Uganda did well. My name is David Wandera. I'm the head of financial markets. I'm also an executive director of AFMI Bank Uganda, for those of you who may not know me. Great. All right, we'll start with Pillar 1 and how Uganda performed. So Pillar 1 basically measures market depth, and Uganda came in at 8th position, 1 position up from the previous year. And why? What drove this? A couple of things. As you can see, the pillar basically measures product diversity, the size of the markets, liquidity, depth, and the primary dealership system. Over the last 1 year, a lot has changed. Significantly, though, for Uganda, we can see in measuring this pillar that we performed better on product diversity. Product diversity, I think also the PSST alluded to it. We saw an increase in the number of products. For example, on the bond offering, we introduced a 20-year bond. It was introduced last 2020, and that led to quite huge amounts of turnover on the secondary market. In addition to that, also we saw that Bank of Uganda partnering or through Refinitiv and Bloomberg saw the broadening of the trading on the secondary market bonds, and we're seeing more activity as a result. If you look at the first paragraph of this, basically you'd see that sovereign bonds increased quite significantly. About 42 trillion was traded in the last 1-2 years compared to what was traded before the primary dealership system was introduced. So the primary dealership system was introduced in late 2020, and it has increased turnover in our markets, basically allowing more people, more offshores to basically trade in our securities. Moving on swiftly, pillar number 2, which measures movement of capital and foreign exchange. Uganda typically was in the top 3 last year, but dropped 4th position We used to always celebrate being the top in East Africa, but we've seen Rwanda slightly overtake us. And the question is, what has changed? There's a general perception, even though Uganda has no capital controls, part of the measures measure how people perceive the control more than, or how they feel what's happening in the economy as opposed to the actual statistic. So survey respondents in this year basically felt that there was less ease, even though there's been no real capital control increased in dealing in Uganda. But when it comes to liquidity, Uganda actually has the fourth most liquid interbank market. What does that mean? Around the 20, when you measure the 23 countries, when it comes to turnover and ability to buy and sell, Uganda is rated fourth. Despite our turnover increasing to over 21 billion as of June 2021, there is something we could do better. And what could that be? Areas for improvement basically would be net portfolio investments, and how do those get more in our country? How do we encourage more investors to come into our country? Our foreign exchange reporting standard has fairly been good because Bank of Uganda has done a great job of making sure that we have all the relevant information that we need. And more than most East African countries, you can find almost anything on our economy if you went to the Bank of Uganda website. So I'd like to commend Bank of Uganda. Dr. Sajabi of the Domestic Financial Markets is here. Thank you very much. Pillar number 3. Which measures market transparency. Unfortunately, Uganda dropped slightly, 5 positions. Why? Why is that? Like Jeff said, there was an introduction of the ESG pillar, talking about sustainable finance. What is ESG? And sustainable finance basically talks about measures that are, there we go, things like green bonds. I know in last year, Kenya introduced its first green bond, and basically having financial statements and measuring companies' performance based on things that create sustainability, protect the environment, and things like that. Uganda has not yet shifted to measure in that way, but those are coming, I presume. Yes, I see a nod. Those are coming. Why? Because more and more investors are looking and being concerned about where they invest their money. Like you've heard from a lot of the oil and gas debate that's been happening, a couple of funders looked at Uganda's oil and gas and thought its negative impact on flora and fauna, and as a result were pulling back. However, like the Deputy Governor said, we still need to make sure that we take and use our resources while we still can. So that's one of the measures that was introduced in the pillar that actually brought down, not just for Uganda, but across the whole index measures, the measure for pillar 3. A lot of the scores dropped as a result. Also, removal of the World Bank doing business report index affected the scores around this, because the World Bank index report was used as a measure for collecting information across all countries, and now that is no longer being published. But I think in a good way we can say, even though the doing business report is not there, the fact that we have the ABSA Africa Financial Markets Index, and in a way it creates various other measures, it proves a guide or shows how guides investors as to where they can invest their money. So that's a positive for us. Capacity of local investors. This has always been a challenge for us. Uganda has not decreased in its performance, and this pillar really measures pension funds under management. I know we have a representative from NSSF here, and whilst we have improved in Uganda in terms of the number of savings that are being made and savings to GDP, we have seen we are still below where we should typically be. The top 3 performers in this index, in this index measure, South Africa, Seychelles, have a per capita pension fund investment of about $1,000. Uganda and 12 other countries along this index basically have a measure of about 100. What does that mean? It means that when you look at the total population of Ugandans, there are only a handful that are saving formally. They may be saving in real estate, they may be saving in assets and businesses, but through the pension fund is still a very, very small percentage. How do we grow that? Those are questions to ponder on and think about. How do we increase the number of products that are being traded or invested in by pension and fund managers? I know that UBRA has basically is driving to train trustees and drive them towards investing in other products beyond government securities. Right now, the majority of our investments, when it comes to local investors and this pillar, are invested in government securities, bonds and bills. How do we move into real estate? How do we move into unit trusts? How do we move into many other options for investing? So those are questions to ponder on when you think about Uganda and think about how we as local investors are performing. Pillar number 5. At least here, I'm proud that Uganda leads. Like Jeff said, if you're looking for areas of East African comparison and competition, when it comes to the macroeconomic opportunity, Uganda is number 1 for East Africa. Up 1 position, and hopefully will continue to grow in this pillar with the new oil and gas and the boost we expect it to bring to our current economy. So what does this measure? GDP growth, export market share, debt profile, living standards, and the quality of banks. Looking at Uganda, whilst we have had increased NPLs over this COVID period, we are still basically doing better than many other economies. In addition to that, if you look at a standard of living, Uganda's standard of living has actually improved, 18% year on year from 2019, from 770 to about 912 GDP per capita. Sometimes the GDP per capita is not a good measure because it's an average, but it is a good measure to show that basically there's been an improvement. More Ugandans have money in their pocket than they were 2-3 years ago. And this is good growth. Someone was actually challenging me and saying that how can we be doing better than Kenya when Kenya is massive? And I say that we are coming from a low base and we are probably smaller. No, we're not. We are definitely smaller, but there's a lot more happening, in Uganda. GDP growth, living standards have improved, and even when it comes to debt to GDP, whilst there has been a lot of talks around our debt profile, Uganda's debt profile is actually one of the best. As you can see, it's amongst the lowest amongst the lowest in external debt ratio to GDP, compared basically to other countries. Even when it comes to debt sustainability, debt serviceability, Uganda's debt serviceability to revenue is about 2.5%, which is still a very good ratio. It means that we are generating enough revenue to actually service our debt comfortably compared to many other countries. So this is a good thing. Then last but not least, I'd like to focus a lot on this, or rather not focus, but basically give it more prominence, because this is the pillar that has resulted in Uganda growing quite significantly, whilst many other countries remained stagnant. This year, Uganda actually moved 51 points on this, and much to the efforts that are put in by the key stakeholders or key partners in this economy. This measure basically measures enforceability of legal agreements, netting. Netting means, for those who are not in financial markets, if all of us owe each other money, instead of somebody waiting for somebody to pay them before they pay the next person, everybody is netted off and you only transfer the net difference. That helps because it increases the speed of transactions and also reduces the hold-ups, because everyone who's waiting to get paid will hold up on paying another person. So because of the new National Payment Systems Act, which has some netting provisions, and also because through Bank of Uganda and Readfront Clear and a couple of other players in the market, there have been the adoption of ISDAs and global master repurchase agreements to enable financial transactions to happen in the economy. This has been a significant win, a big change from where we were before. As you can see from the measure, it moved quite. We got almost a full max on netting position enforcement and standard market agreements. Basically, it means that people can come into Uganda and transact comfortable, that they'll be able to have efficient settlement and also be protected from a collateral point of view. This is a big win, and many thanks to Bank of Uganda for leading this initiative. Thank you very much. So we have a bit more left coming ahead. Jeff will be coming to talk about, I think, what a lot of customers are looking forward to is the economic outlook. So I don't want to spend too much time, but I just wanted to show a snapshot in terms of the pillars. If you can put up the presentation to see where Uganda is and how we performed across all pillars. Generally, the places that we still need to focus on are the places where Uganda has performed lowest. One is capacity of local investors, where we are at about position number 11, and then between market transparency, I think, is then the next one. Tax and regulatory environment. When I think about tax, one of the things you can compare across East Africa is Uganda still has the highest tax on dividends for Ugandans and East African investors at 15%, compared, for example, to Tanzania, which is at 5%, I think, and Rwanda and Kenya are all at 5%. So there are some elements in our tax that we can improve. A couple of years ago, we improved the tax on long-dated bills and bills by reducing them from about 15% to 10%. However, there are some countries that are still doing better. So those are some of the areas that we can focus on to improve. And I liked the PSST's comments that there are some improvements they are looking to do. Rather than increase the taxes, widen the tax base, even widen the revenue base. That way, we will not have higher tax burdens as individuals, those who are compliant, per se. So I would like to invite Jeff to come and quickly go through the economic outlook, and then right after that, please keep your comments and your questions. We will go straight into the plenary, where we can now have a full discussion on how Uganda is performing and the areas for improvement. Thank you. Thank you, Jeff.
So it's unusual to be given an opportunity to speak twice at the same conference. I think in part that reflects the last 2 years we've been locked down, and so we're not able to go anyplace, COVID. And if we look at the oil price currently, there's a real fear that over the next little while we're not going to be able to afford to fly anywhere again, but for very different reasons. We're going to take a little bit of a detour away from the financial markets index now for a moment. We've heard fabulous overview and thoughts and views of what will help drive the future, both from the Permanent Secretary and also the Deputy Governor, for the way forward for the Ugandan economy. I'm going to share some similar thoughts there with more graphs, essentially, is the approach that we're going to take. So one of the first observations here is that as challenging as the last 2 years have been, individuals and looking to provide for their families, businesses, and trying to find a way forward in this environment where the economy is heavily restricted, broadly speaking, East Africa did relatively better than the rest of the world through this period. The graphic in front of you right now takes 2018, sort of how things were going before COVID. Then you see the dip down for Uganda, Kenya, Sub-Saharan Africa, the global economy. Tanzania sort of more or less ignoring this as the top line in that space. But what you see there is that economies here are significantly larger today than they were pre-COVID. And that's really telling. I visit you from South Africa. We're still several percentage points smaller today than we were before. So if you think about the challenges of running a business in the environment here in Uganda, imagine the difficulty other parts of the world where the recovery has been much less robust. That said, and this is true globally and regionally, and it's certainly true locally as well, different parts of the recovery different parts of the economy have recovered at very different paces. So the table in front of you right now says, well, the last quarter before COVID hit, the end of 2019, compared to the quarter, the most recent that we as economists get data for. That's only the third quarter of last year, so July through September. We'll get the last quarter of last year in a couple of weeks' time. The overall economy was 1.5% bigger over that period. So it shows the reflection of this dip down through the restrictions and then starting to get a little bit bigger again. In that space, there were some real winners. When we met last time for the Financial Markets Index, a number of us, including myself, had to remote in. It's no surprise in that space that the telecom sector globally has done pretty well in this environment, about a quarter bigger already in the third quarter of last year, despite the restrictions, than had been the case before. Construction sector, right? I mentioned my drive in last night, the 25 kilometers with heavy yellow machinery making further improvements. It's always remarkable for me. The construction sector, even in the height of these restrictions, about a sixth bigger than it had been before COVID. Agri, really going from strength to strength, notwithstanding periods where growing conditions are very difficult. But trade, that's wholesale and retail trade, down about a tenth. Transport sector, a little bit more than a tenth. Manufacturing, despite this longer term story of manufacturing becoming an ever increasing important part of the Ugandan economic story, manufacturing struggling in this space. And of course, accommodation and food, regional travel, right? Global travel, really down an awful lot. So the overall economy looks resilient, but within that space, wildly different experiences depending upon how close that business was to social distancing. And so we think about the sort of interventions led by government. You think about the sorts of efforts by banks in order to ensure that the next part of the recovery from COVID goes as well as the previous part. Well, it's going to be focusing on these sectors that have the most to return. Now, there's plenty of evidence, more recent data, that the economic recovery continues to gain steam. Graphic here is looking at a composite indicator of economic activity. That's the line just almost always goes up. It's a net balance line, which is around business tendency above 50, means businesses think that tomorrow is better than yesterday, and they're starting to grow again. So plenty of evidence from data right through to early parts of this year that as the lockdown restrictions have vanished, as the economy is able to reawaken from this forced slumber, that the opportunities are being seen out there and acted upon. And to some extent, that's being aided or reflected in private sector credit extension as well. Credit extension is growing kind of 8% right now. I would expect that that is likely to accelerate as businesses see new opportunities and are able to start to invest towards it. But I also guess this is a great opportunity for those of you from the business sector here in the room to sort of lock eyes with your banker in the room and start to have those discussions. Certainly the broader environment, and I know now we're almost certainly going to want to talk about Russia and Ukraine, but there's a broader environment story that talks to us about the recovery in a post-COVID environment. And part of that is going to be around global travel. And within that, it's tourists, of course, but it's also the normal travel of business people and investors coming to grips with the situation on the ground and gaining comfort, not just from raw numbers, from getting a sense of the people and the opportunity. The data in front of you right now is a very confusing graph. I've taken it from the aviation industry. And effectively what it shows, in the blue line at the top, 0 means that travel is right back to where it was before COVID. So you see that everything on this graph is some version of quite a big negative. But what it's showing is that globally domestic bookings are closing the gap more quickly. You can see that domestic bookings slipped when Omicron sort of hit globally, but not by as much as in previous waves. You'll see that the lower line is international travel. There's a lot more recovery that still needs to take place there, but the same notion that Omicron, despite having infected vastly more people, than earlier waves, because it put fewer people in hospital, because more countries had made better progress around vaccination. And it's really heartening to hear the success in Uganda in making progress in that side, that the impact on travel is somewhat less. That said, travel, whether it be for business or pleasure, are one of those industries where individual countries can only do so much. Being able to tell a very positive story in Uganda about the COVID environment helps. But if neighboring countries find themselves in a more difficult situation, the likelihood of people getting on planes in Europe and coming to the region is that much less. Coming from the US, coming from Asia. I would also say, and I'm no global travel expert, but in an environment where the headlines in Europe are around war, there are going to be fewer people right now thinking about their summer holiday plans, right? And more people being a little bit fearful about their futures. And holidays aren't things that you do when you're fearful. They're things that they do when you're confident. Now, one of the critical and positive stories that we have here in Uganda is just the investment story, right? And in part and parcel, the improvements in the financial markets index help tell that story. Makes countries that score better in the index tend to be countries that are easier to invest in. Uganda's gone from 10th place to 5th place. Part of the story here is, of course, oil. I'd mentioned in my opening remarks 20 or 30 minutes ago that my first visit here to Kampala was back in 2004. And I'll put my hand up and say I can't quite remember whether it was my first visit in 2004 or my visits in 2005 or 6, but it was around that period that I first started having meetings around oil. And the notion that oil was found, contracts were close, and it was sort of a 2 or 3 year story. Now the happy thing is standing in front of you right now in March of 2022, final investment decisions have been made on major projects. Major decisions have been made on pipelines. It feels real now. But gosh, it's been a long time coming. And imagine how different the economic talk would be right now with oil at, I haven't checked this morning, oil at $130 or $140 a barrel, were we pumping today and not pumping 4 or 5 years from now. So it's fabulous news we're making progress in this side. That investment will be transformative for Uganda as an economy, right? And this investment story more broadly is one of the reasons why it's not just last year, despite the COVID restrictions. We think that Uganda grew at least 5%. We think that Uganda will grow another 5% this year. And you think about our medium and long-term forecasts, therefore higher numbers still. I won't touch too much upon the recovery program because the Permanent Secretary spoke very eloquently on that. But let me, because I'm an economist, rather focus on challenges, because that's why we make such downbeat dinner guests, I suppose. Inflation is an absolutely critical element of the story right now, globally. And it's tricky because what we're seeing in the headlines and the things that we're worried about are only going to start reflecting in the data that's released over the next 2 or 3 or 4 months. So we know that when Bank of Uganda met to discuss interest rates in February, this wasn't months ago, it was weeks ago. At that point, the discussion was that inflation had been rising a little bit from the mid-2s to the low 3s. It was being driven to an important extent by energy and food. The expectation is inflation would probably continue to rise, and we know that that generates real strain for all of our people, but also that it would be likely to remain comfortably within the central bank's targets. Our own sense as a research team is this was probably consistent with a little bit of interest rate increases. I know no one ever wants to hear that, but our published forecast is that the Bank of Uganda rate would probably go up by about 50 basis points around the middle of the year. But all of this outlook is now with a big question mark over it, right? At the end of last year, roughly speaking, global oil prices were about $75 or $80. This morning, they're somewhere around $130, $140. Global grain prices in the last week have increased by about 50%. Sunflower oil prices have increased by significantly more. We're starting to see lots of tension points across many parts of the global commodity market. And beyond that, in the same way that we've learned over the last year and a half about how complicated global supply chains are, I suspect we're going to find out lots of little hidden bits of global supply chain that are very much impacted by financial sanctions on Russia and by Ukraine's ability to supply. As a tricky little fill-up in that, neon. Don't really think of it very much except for sort of US-style diners and those fabulous signs that they had in the 50s and 60s. Neon is a critical input into making computer chips. Has to do with the lasers that are used to set out the boards. Ukraine supplies 70% of the neon that's used in that process. So the global supply chain impacts from what we're seeing in Europe right now may well go a long way beyond just making it more expensive to cook our dinners or put fuel in our cars or to provide food on the table. One of the challenges in this space is that the ability, the room that governments have to support their economies when faced with another negative external shock is probably lower today than it was 2 years ago, when the emphasis was trying to lean against the impact on households and on businesses and financial systems from COVID itself. It doesn't matter where we look globally or where we look on the continent, there's a lot more public debt out there now than there was before. Roughly speaking, debt to GDP here in Uganda went from a little more than a third of GDP to about half of GDP in the span of about 2 years. And that's challenging, right? Depends a little bit on where that debt is financed from and what currency it's in, etc. But more debt means less room to maneuver going forward. And we don't need to think about that through the complicated lens of the national treasury and looking at how to run a government. We can think about that as we run businesses. The more leverage our business has, the less able it is to withstand a downturn because it's just that much harder to free up working capital. We think about it as households, right? The less money we have in the bank at the beginning of the month, the more debt we have to the bank at the end of the month, the harder it is for us to withstand a temporary delay in payments to us. And countries are exactly the same. And so the goal of government right now is to try to quickly reduce budget deficits, to restrain debt from getting to the point where it becomes a real encumbrance for the country as a whole. But one of the things that means is the ability to really support against high fuel prices, against high food prices, against other challenges that look likely to appear as a consequence of Russia-Ukraine. The space there to help out is just that much less. I think it was last year, but it may have been the previous year, one of the discussion points across the region, very active one, is the debt sustainable, right? Often it's a very political discussion. There's no clear and single way to say that. What often as economists we use is some work done by the International Monetary Fund. And they do a debt sustainability analysis. It tends to be very quantitative in nature. And at the end of that, you get a rating, right? Your rating is that you are at mild risk of debt stress, you're at moderate risk of debt stress, high risk, or you are in debt distress, right? And so what we've seen across the continent are countries, for the most part, moving in the wrong direction. Moving from being okay to probably okay, not so okay, we're really worried about it. And certainly in that space, Uganda has been part of that movement. But as you can see on the graph on the left, the second bar from the left is Uganda, sat there with Tanzania sort of comfortably in moderate risk. Rwanda gives us some sense of how much space we have to go and stay in that same category. But if you look elsewhere in the region, Kenya's already listed as high risk. Ghana is currently struggling to access global financial markets. Zambia is in active debt default. So there's a lot of strain out there, which suggests that public finance has less room to maneuver than it did before. And that has a broad implication. So my last thoughts here, before I hand off, are just going to be around things driving the exchange rate, right? So in that space, if the same way you want to think about public finance is as you do your household, your earnings for the month, right? Your spending for the month, and the savings or debt that you have and the space that that provides. For countries as a whole, when we think about balance of payments in current account, economists like to discuss this in very complicated ways, but in a practical way, your current account is just everything you sell to the rest of the world, goods and services, versus everything you buy from the rest of the world. And you know as a household, right? If your income every month is less than what you spend, you can do that for 1 or 2 or 3 months. You do that for more, you got to get friendly with the bank. If you do that for too long, it becomes less friendly with the bank. Countries face the same sort of thing. So we've had a period here where the current account deficit, generated by a trade account, Uganda buys from the rest of the world less than they sell every single quarter. And in that environment, if we think about what's going on with global food prices, right? If we think about, in particular, what's going on with global oil prices, the strain on this side is likely to get significantly larger than it is to stay the same or smaller. So it isn't to say that the country isn't a positive growth story, that there's not a fantastic investment case to be made, but it means that it's getting harder and harder for the currency to stay in one place rather than ratchet a little bit weaker. And oil in this, and our little back, I was doing some quick calculations on the table to the right. I think every $10 in the oil price, if sustained for a year, is worth about 130, 140 million US dollars more that Ugandans have to send overseas for the same amount of oil. Now that's $140 million that could have been spent on Ugandan product. Now we've gone from $75 to something about $50, $60 more. That's 2/3 of $1 billion for the same amount of oil, right? The pressure is significant. Remember, it's grain prices and others as well. So in that space, the great news is that we go into this more difficult period. Bank of Uganda has more significant foreign reserves, so there's sort of more firepower available if needed. We've seen over the last 12 months that the shilling has actually appreciated a little bit, 2.5% against the US dollar. Not as strong a recovery as Zambia has made, coming from sort of an outright crisis. Certainly a much better performance than we've seen in Ghana or Mauritius or Botswana. But going forward, and so we'll get a sense here from smiles or frowns as who in the audience is an exporter and an import or an importer. But our forecast for shilling for the end of this year is a number like 362. For the end of next year is somewhere deep into the 370s. And that just reflects an environment. Global risk aversion is higher. Uganda's need for funds will be more significant, right? And those two things coming together make for a more challenging environment for the currency. I've got a couple more pages with forecasts or what have you, but I know that we can circulate those for anyone who's interested. Let me leave my final thoughts here by just talking about what we're watching. Obviously, geopolitics, right, is absolutely critical right now. In the very near term, we're watching it because we need to understand how it impacts the price and, frankly, maybe the availability of some of the things that modern economies need and able to function smoothly. But there are longer term questions here about a global order, about a rules-based system, right? About decarbonization, frankly, and whether that accelerates an environment where the goal is to cut Russia off from the rest of the world. It's about COVID as well. Omicron in the end turned up to be relatively benign for health systems, so I don't want to be insensitive. There was still an awful lot of deaths, an awful lot of families and friends and colleagues were impacted. but not quite as significantly as in previous rounds. But we're not done on COVID yet. There's a discussion around budget and budget setting here, trying to match the need to consolidate, right, to bring deficits down, but economies that will still have vulnerabilities and perhaps some new challenges through Russia, Ukraine. Of course, there's always a challenge around domestic security concerns. I was here in this very hotel in July 2010, for example, during that period, and of course I know there's been additional and important challenges since. It's about volatile weather conditions, right? We think about bread baskets of the world. We think about the vibrant, verdant Ugandan countryside and the ability not only to feed people, but also to generate the inputs to that industrial process, that manufacturing process to help feed the rest of the world. And then it's oil developments. Those are the critical things we're watching. I'm going to hand over now to our panel discussion and Q&A. That's a little bit like you seeing me 3 times today, but I'll sit in the corner, I promise. Thank you.
Thank you very much, Jeff. I'm sure you all have so many questions, but this is all going to be handled during the plenary. So please allow me to hand over to Dr. Sejaka for the next session. He needs no introduction, but for those that don't know Dr. Sejaka, he's an accountant, he's an economist, he's also a professor, and the country lead at Matt Abacus Business School. Doctor, you're welcome.
Thank you very much, Master of Ceremonies. I think we've been seated for a very long time. Can we stand up? Can we all stand up, please? You need to stretch that body, right? You need to feel nice. You can bonga with your neighbor, since you can't do a handshake. Okay, bonga with the neighbor, another one, another neighbor. Okay, please take your seats. I'm waiting for you to take your seats. I can see people really needed to greet each other. So we've had all the top gurus in this country talking, and we've had Jeff Gable giving us this report. I'm now going to invite some technical people up here to give us their view from where they are seated. I will start with David Sajabi from Bank of Uganda. David, are you here? David, you're most welcome. Yes, David is an expert in financial markets, and I know he will say more about what the Deputy Governor has said to us regarding the plans they have for us. David, you're most welcome. Please come up. Next up here is Ibrahim Buya. Unfortunately, I'm above 45, and I have nothing to withdraw anymore from the NSSF. But Ibrahim works with the biggest pot of money in this land. He will come and tell us how big it has been growing over the last few days, and what we can do to use that pot to grow our financial markets. Ibrahim, you're most welcome. Okay. Up next is Council Miriam Musali. Miriam, where are you? Miriam is a legal brain, and she has worked with the Capital Markets Authority for quite some time, and she will analyze the legal aspects of this debate for us. Jeff, you can't run away from this. Please come back here. David, come and give us the Uganda perspective. So this is our panel. I know those who are concerned about gender matters will complain about the imbalance. So I apologize up front. So ladies and gentlemen, I'm not going to repeat what you have heard. I'm just going to mix it up. I'm going to mix it up so that I make it a bit controversial. And that's how I'm going to earn my lunch, right? I'll start with the good news, right? The good news you have heard is that recovery is underway. We should expect more investments and an increase in more travel internationally, and that should bring more tourists this way. The other good news I think that I've picked is COVID is history, even though that was indirect. I think that is thanks to Omicron. Omicron is a vaccine we have been looking for. I am no medical doctor, even though I sit on the board of a medical hospital. But what the doctors there told me is that viruses have such a nature that they mutate so that they can survive. So COVID is going to become like flu, and life will go on. That is the good news. The bad news, watch Russia and Ukraine. This thing has become a proxy war, okay? And we thought the Russians thought they would have this done in a week. I think it is now festering. So it's going to have a lot of implications for commodity prices, and that has been put out to us. I think the sanctions are also going to have a lot of effect on underdeveloped economies like ours. And that means inflation. Again, the bad news, oil prices. But that is also a mixed bag for us because we have our oil. Jeff, you said that you started talking about oil in 2005. The good news is we have FID and we are moving. So I hope we can get this oil out now while the big boys are fighting. You talked about debt sustainability. I have a problem here and we can debate this. The issue of debt sustainability, I was looking at data of debt for countries like Japan. The debt to GDP ratio for Japan is 120%. I don't know what it is for the USA. The thing is, we must start thinking for ourselves. The issue about debt is the ability to service the debt. It is not the size of the debt. And I think for Africa, we are constrained by our ability to service debt, especially when we don't have printing presses for dollars and euros. The bad news again is climate change. And this is the elephant in the room. The pressures are increasing, and it's going to have a lot of implications. So, with that background, I want to now call upon our panelists. I think I will start with David from Bank of Uganda. David, you have 5 minutes. From where you stand, how can we improve our scores in the areas where we have poor performance? We've talked about market depth, and we've talked about the capacity of local investors. What do you think we should be doing? Definitely, we have improved coming from where we have been, and the PS highlighted this. So what should we be doing next to get better and better? David. And then you will be followed by Ibrahim. You're sitting on a large pot of money. What innovations can be done? How can the capital markets people help to help you invest this money better? You could speak to that. And then again, Miriam will respond to that. Then Jeff and Gebo, you will come in and summarize. You all have 5 minutes, and then we'll open this up to questions, and you can then respond. David, you're most welcome. You want to speak from there? I think it's better from there. Okay, so that we're faster. Okay, David, off you go.
You. Yeah, David Sajabi is my name. The Data Financial Markets at the Bank of Uganda. When I was invited as a panelist, I asked David one day that, how can you invite me as a panelist when my bosses, the deputy governor of the bank and the permanent secretary, the secretary of treasury, finance, are going to be presenting at the same function? But now I understand why. Because I think due to their heavy demands, they've excused themselves. So, but please, for the so I wanted to invite you to ask the very hard questions, because I thought they would be here. But now that they are not here, please don't ask the tough questions. I may not be able to answer them. So, in the interest of time, I'll, the elder's word is the word, so I'll not again go through what the Deputy Governor and the PSST have ably presented. But just in terms of what we can do better, or what we're even doing going forward to improve our rankings. Our first is we are seeking to list on the Bloomberg Africa bond indices. We want to get our bonds internationally listed. And this Bloomberg African bond index is just a stepping stone. And as the Deputy Governor mentioned, then thereafter we'll seek to have our bonds listed on other frontier and emerging market indices. Second is how do we go down to the local people to encourage them to invest in our markets, in the financial market, make it easier for them to buy bonds, treasury bills. We have a project we are working on with the Ministry of Finance. This has started. It is called Project Oksaving. This project will enable the ordinary person to buy a piece of government securities through their mobile phone, as low as 100,000 shillings. One can buy a piece of bonds through their mobile phone. So we want to make it very easy. Easy paperwork, no need to go to any institution. You can easily register from your phone and start participating easily. And make it easier for people to come in, to walk in and walk out, if they so choose. We are also working to launch the umbrella guarantee facility that will protect banks from exposure to credit risk of borrowing. As you may be aware, there is a bit of segmentation within the banking industry. Smaller banks, big banks may not feel as comfortable at times to lend the smaller banks, but through this facility, we'll remove that risk, that credit risk, so there should be more interbank trading among the banks. As mentioned earlier, we are also linking the Bank of Uganda, CSD, this is the Central Securities Deposit, to the USE CSD to facilitate trading of government securities at the stock exchange. This linkage will over time go through to other platforms, including Bloomberg and Refinitiv. We are also in the process, again, working with our counterparts, regulatory agencies like Capital Markets Authority, Ministry of Finance. We're in the process of setting up a bond governance and oversight framework that will make it easier to bring all the stakeholders on board in as far as financial markets developments are concerned. And lastly, is the local clearing on international platform, such as Clearstream and DrawClear. This, we hope, should significantly reduce the volatility of the exchange rate related to portfolio flows and decrease settlement risk through a central counterparty. I think in the interest of time, moderator, those are my submissions in terms of what we are doing and what we intend to do going forward. Thank you.
Thank you very much, David. You've kept on the straight and narrow. But omuntu wawansi, the person down there does not feel you. Maybe Ibrahim can speak to this. Ibrahim, you have seen from this report the capacity of local investors. In 2017, we scored 13. This year, 2022, we've scored 16. And it points, for me, it points back to, unfortunately, the people from Ministry of Finance are not here, but it points back to the bigger picture which we have in terms of how we want to grow this economy. Yes, we don't want this to be a command economy, but what is the role of the state in preventing us from becoming a complete border economy? So how do we do away with that informality? Ibrahim, over to you.
Thank you. Morning, everyone. So I work at the NSF. I run the fixed income portfolio. So I believe most of you are members of the NSF. It is the largest single fund in East Africa. It's closing to about $5 billion. It's easy to speak in dollars because sometimes they tend to be more stable than our own currency. So it's a large fund by Ugandan standards, and it's a growing fund. Now, when I see the report, I looked at the report before today, and we are talking about the capacity of local investors. And Uganda seems, largely measured around pension funds, seems not to score well. When the NSF is a flagship for the whole of Africa now, in terms of our investment performance over the years and our behavior in the financial markets, I think it's the only single fund in East Africa which invests across East Africa and which has sought to get value for its members across all these three East African markets. So part of the measurements or indicators within this report are things we face every day. How do I look at the liquidity of the other East African markets in terms of FX? How do I look at the governance of some of these markets? How do I look at the transparency? And to be honest with you, for someone who practices this every day, I would rank Uganda ahead of the rest without any sort of hesitation. Yeah? We are in a country whereby I always argue that we have the best central bank. As one mentioned, you look at the transparency, the quality of information you get on the BOU website, you can't find it in any of these East African markets, even if you did what? You look at the way the bond market in Uganda, despite being small, it's a dealer market, not a broker market. The Kenyan market is a broker market. You look at how the transparency of the auctioning process happens, you cannot compare it to anyone within East Africa. The timeliness within which the results come out, you compare it to the rest of the East African countries where I participate, you can't, we are miles ahead. So I think on that part, therefore, I urge you that you would want to understand how the various factors within these various measures within this report are weighted, okay? To understand what could make perhaps Uganda a bit different from the others as well. Because I believe if I look at Rwanda, today if I made a call in Rwanda to raise $1 million right now, they'll give me a week to raise it. When I call David for $20 million now on the phone, I'll have it in about 3 minutes. So those things and many other things, I think I'm proud of the country we are in terms of the policies which have been achieved over the years, and in terms of where we are headed. Now, to speak straight to the pension funds and the capacity of local investors, we are still a small market, albeit growing. Yeah, we've been seeing growth rates in terms of pension assets, which were above 20% pre-COVID. That growth has come off because it did two things to the source of pension growth. One is it had returns, natural source of growth. Secondly, the members themselves, employment issues came in place, so you're not growing in terms of numbers, but also salary growth. If you look at the NSF over the last couple of years, most of the growth that comes from contributions has been coming from salary growth, more than from increase in number of new members. So that sort of thing was sort of tampered with because of COVID, and we saw a bit of a stagnation in the growth. We didn't decelerate, but we didn't grow as fast as we've been growing over the last couple of years. I don't think that growth has recovered as I speak now. Now, how do we play in the market? About 90% of our NSF assets are invested in formal markets, because fixed income is near 80%. These are typically largely government bonds. Those are capital markets. About 14% is near equities across East African markets. Obviously, our market is still small in terms of equities. What are pension funds doing now? Because the pension business is about trying to match your liabilities with your assets alongside your liabilities. Now, we are seeing the liabilities changing. Yeah, the moderator spoke about the midterm access. The midterm access has just implied that liability is becoming short, because now members are accessing money early. And I have a feeling, or I believe from where I sit, that we are just going to ask for more and more of these. So whatever innovations that come in the marketplace will be innovations that will enable NSSF now not to just look at the long end we've been crying for. A few years back, we were asking Bank of Uganda to introduce 25-year, 20-year, 25-year bonds, 30-year bonds. We will ask, but now in a bit of a reserved fashion, because the member, the owner of the money, is saying, no, I don't want my money kept for 25 years. I want it perhaps kept for an average of about 15 to 20 years. Maybe the other thing I can talk about, what could improve what could attract people to the markets, because the people to bring money to NSF is a result of the performance of the NSF. Any pension funds that comes in place, are we giving them value? If we give them value, then more members will seek to put money in formal markets, like through pension schemes and stuff like that. But Uganda is unique. It's the only country I know of in East Africa where pension assets are fully taxed. The performance, the returns of pension funds are fully taxed. So the rest of East Africa and the standard globally is that most pension funds are not taxed at all. But here we are fully taxed like any corporate institution. Like one mentioned earlier, we had a 20% WHT on government bonds a couple of years back. We reduced 10%, I think, about 2 years back, and we've seen the impact it has had on the yield curve. Yeah, rates have basically come off because more people are being attracted to the market. You look at a market like Tanzania. Tanzania has a 20-year bond, and all bonds above 2 years in TZ are not taxed. And the one who dictates the yield levels on the 20-year bond in Tanzania is the retail investor, not the pension funds and everything, because it's been so attractive to retail investors. It came all the way from 19% about 2 years back to now about 12%. But the one who is governing the pricing, how it auctions in the market, is the retail investor. So one of the things we'll have to look at in one way or the other will be how the taxes and whether they are optimal. Are we scoring our own goal by some of these taxes in place? Thank you. That's where I can leave it.
Okay. Thank you very much, Ibrahim. Miriam, you've had Ibrahim telling us how he has $5 billion US. I think for us observers of the market and bit part players, our biggest complaint is lack of imagination. No offense meant, Ibrahim, on the part of the fund and on your part as Capital Markets Authority, because the limit, the framework within which this money can be invested seems to speak to a lack of versatility, because we have, at the same time, we're talking about borrowing money for things like Karuma, standard gauge rail, and so forth. Where are these infrastructure bonds? What is the capital markets thinking about us using some of this money generated locally to invest in this? Why should we be growing debt while all this money is sitting with the NSSF? And actually, when this money keeps on sitting with the NSSF, we people who are hungry begin to look at it because it is there. You know, it's like the other gentleman who climbed Everest. When he was asked, why do you climb Everest? He said, because it is there. I forget his name, but I remember. So I want to put it to you, don't we need some more imagination in how the NSSF pot is distributed in terms of improving the quality of our markets? Over to you, Miriam.
Thank you very much, Chairman, for this. I'll just make comments around 3 pillars. And the first one that you're touching on is really to do with the market depth. Now, when we think about market depth as the Capital Markets Authority, we are looking at 3 things. We're looking at the fact that you cannot have deep markets when you boast of one big fund. And that's the biggest issue I have when it comes to the reform of pensions in Uganda, that we have not grown the pension sector because the reforms have not been holistic. When I joined the Capital Markets Authority in 2005, I had just come from law school, and I was the secretary to the Subcommittee on Regulation and Liberalization. And the things that we said in that meeting, we have only taken 2 steps forward and many steps backwards. So we have to bring back the debate to the table on holistic reforms in the pension sector. If you look, for example, at our counterparts in Kenya, Kenyan pension funds have come together in a consortium to fund infrastructure projects in Kenya. The Retirement Benefits Authority in Kenya has allowed these pension funds to invest at least 10% of assets under management in infrastructure projects. But what are we doing in Uganda? We're not doing the same thing. So we are moving backwards in terms of reform. Who are the biggest consumer of capital markets products? It's institutional investors. So if it's institutional investors, they're the ones that are going to grow our market. The CMA has put a lot of effort on retail investors, and now we are championing collective investment schemes, and we have assets worth about 1 trillion shillings. But you cannot compare that to what Ibrahim has at NSSF. So we need more pension funds that grow, that can consume the products in the capital market space. In terms of the capital market space, when you look at Pillar 3, market transparency, tax and regulatory environment, Uganda is at 60%. The reforms that we are undertaking in capital markets as a result of the 10-year capital markets master plan are to make sure that we reform raising of capital. So we have offer of securities regulations that are being drafted to simplify the process of coming to market, whether it's at IPO level for the primary offering, or whether it's at secondary offering, or whether it's with the corporate bonds. We have laws that allow entities to seek financing other than non-bank financing, but these have not been exploited. So we are looking to see how can we bring more products. We are also redefining securities in our capital markets framework to allow for other products, ETFs, for example, to be listed on the exchange, to be backed up by underlying instruments. So some of these reforms are incomplete if we do not have strong institutional investors. When you look at the ABSA report, a big problem is liquidity. This is a problem in many African markets. But how do we improve liquidity? We cannot improve liquidity with one fund, because that one fund will buy and hold. So they will hold the stock markets hostage. If Ibrahim doesn't sign off to say we will participate in a bond issuance, we shall participate in an IPO, what happens? It's undersubscribed. What if we had 5, 6, 7 funds? Would see more liquidity, would see more activity in the markets. So this is very critical if we want to see these things happening. In terms of capacity of local investors, we are also happy to say that we are working with the financial sector deepening. We have the deal flow facility that is being hosted by Financial Sector Deepening Uganda, and we appreciate them for this. This is a project that is also being financed by the European Union. So what we are doing is we are looking at companies that we can make market ready. These companies have applied to be part of this deal flow facility. They are being given training in governance, and they are being made ready like a bride is made ready for a wedding. We are making them ready for the market. So we are very excited about the deal flow facility. We expect to see more there. We are also grateful to government for the policy, the broadband policy that saw MTN list on the market. Unfortunately, some of the people in this room, you may not have participated. So it was undersubscribed. So we are warning you that when the next telecom lists, participate. The market is ours. Government has given a policy to compel listing. Ugandans are busy analyzing, taking capital markets to court instead of participating in the listing. And so we are having more foreign investors buying into the listing. So I think we need to also put our money in the things we are trying to promote. And as capital markets does its job, can we also do our job as Ugandans? Can we invest in these companies? Can we issue corporate bonds? Can we reform the pension sector? These are the things that are going to help us to defend our status in this ABSA index, or even get better. So thank you very much.
Thank you very much. Miriam, you've really given this fire. And I like that fire. But I think it was unfortunate that the reform of the pension markets kind of stalled. The other thing that I think you've talked about is collective investment schemes. And I see a move by URA to impose taxes on unit trusts. That is also very unfortunate if it does happen. But PSST has been here, and he has told us that they are not going to put any more new taxes. I hope he will live up to his words. But you remember the American president who said, "Read my lips." So I don't know. Jeff, I'll give you 2 minutes to say something about the comments that have been made by the panelists, and then David, and then I'll open it up. But then again, I think the key issue really that should concern us is the areas where we perform poorly. People say, when Helen was introducing me, she said I'm a teacher. I'm not only a teacher, I'm also an investor. And I can see my co-investor here, Dan. We are investing in the Namamve Park. And no bank would want to touch a Ugandan investor like me. So I am building this factory in Namamve with my savings. No country can grow like that where the local investors are on their own. And this is a challenge. Maybe we will speak to this. But how do we overcome this? And this is why I'm saying, when you look at the level of growth you are seeing in Kenya, in other markets, you look at the level of investment by their business people, it is because of their access to financing, which is affordable. How are we going to deal with this problem, given all the other bottlenecks? But before I open up to the plenary, Jeff and David, you have 2 minutes each.
Thank you. First, let me just say that if the buying of retail bonds is open to people with funny accents, you must just send me the link. I'm more than happy, to generate in that space. We've had a lot of discussion around Pillar 4, because assets under management, the capacity of local investors is always a topic that is really vibrantly discussed. And maybe just a moment to to reflect on how we measure it in the index and why we measure it that way, because it's quite a narrow but in simple way in which we think about it. One, we reward countries that just have more assets under management, and we divide it by the population. So in that space, the idea is that if you have more people, you should have more assets. Kenya should be bigger than Uganda. Uganda should be bigger than Rwanda, for example. And we know in that space, it isn't Uganda alone that has a real challenge, that the pension assets per capita, per person, is a very, very modest number. It's barely more than $100, I believe. And so if we can imagine in this room being asked to retire on $100, right, you'll be taking some more of the donuts and pastries with you when you depart today, hoping that lunch is free as well. The second way in which we measure it is to this issue of liquidity, right? The idea, it feels sort of strange because pension funds by their very nature should have a medium and long-term focus. I think the point that you made, Ibrahim, was a very important one. At the same time, we know that it's difficult to encourage other types of investors into a market if everything there is buy and hold. So we try to introduce that tension into the pillar by saying it's not just that we want as many assets under management as possible in the pension fund, but somehow we want the pension fund community to also be trading. We want that price discovery. And that is always going to be a challenge in the early parts of pension fund development. But that's how we score there, in a little bit about why we score in that space. More than happy to share thoughts around debt and debt sustainability, but with my 2 minutes, if I could use the last few seconds to also commend the data availability here. So pillar 5 in the index, it's called sort of the macroeconomic pillar. And often we think about it, countries that grow faster score well on that pillar. Certainly that's true. But remember, the index is about financial markets, not just about economies growing. And within financial markets, we want to make things open and accessible and transparent. And so one of the critical focuses in Pillar 5, and Uganda does really well in this pillar, is making sure data is available, that things are open and transparent. And so it's not just making a job easier for myself and my research team if we can go to Bank of Uganda, or we can look at economic planning and find all of this timely data for us to understand. But it also makes it easier for international investors, for domestic investors to understand the environment that they are going to be investing in. So kudos and superb work on that space. Thank you.
Okay, thank you, Jeff. David, you wear the shoe. So you have the last 2 minutes, and then we open this up to
Thank you, Chairman.
Q&A.
Thank you, Chairman. Just a few comments to Ibra's defense when he said he came to talk about a lack of innovation and...
Sorry, it is not Ibrahim's problem.
I know.
It is not his problem. I think he would like to invest in more things, isn't it?
Yes, he would.
It is just the law, the way the law is, right?
Perfect,
Okay.
yes. I just want to clarify for those who are listening that, and it's good you have said it, that the law is what is restrictive at the moment. And strangely, even if the law allowed for product diversity, right now the product diversity is outside Uganda. If they allowed NSSF, for example, to invest outside Uganda or the pension funds, locally we do not yet have those products. Why? The product is a function of the investor understanding and the ability to tolerate the volatility and the risks with those products. So we need to walk some miles as an economy or as investors, domestic investors. And to tie in with that, I know that CMA has a retail investor education plan. I know it was curtailed with the onset of COVID, but now that COVID has gone, I hope we can see more. Not just CMA, but also Bank of Uganda has also a financial markets development plan, I know, which has been in place over the last 10 years, basically to try and get more participants into the financial markets or participating in the financial markets beyond the fund managers and the international institutional investors? How do we get the retail investor to understand? I think those are areas in which provide opportunity for growth and for the Umuntu Awansi to understand and to play and take part in that. Then I was just thinking about product innovation and what could be done to improve the products. I know from the supervisory point of view of Bank of Uganda, there's a regulatory sandbox that's allowing for banks to innovate. If something could be done in that respect with regards to product innovation and trying out of products that drive investments, between CMA, Bank of Uganda, and the Ministry of Finance, because financial markets development fundamentally all goes to fall under Ministry of Finance. So those initiatives working together with the various stakeholders could actually drive more understanding. And really those are the few comments I would have on that. Thank you.
Thank you very much. Now, I don't know, Helen, are you going to help me? We are going to open this for Q&A. Please don't ask the moderator questions. Ask these experts around me the questions. Okay? Yes, there's a hand over there, Helen. Please say your name and ask a question. Don't give another essay.
Sure. Good morning, everyone. My name is Susan Namaganda. I really thank ABSA for inviting us. I think this is the first physical after COVID. We have been attending online, but it's good to see people and familiar faces. Well, from the discussion, I would love to see, the banks in Uganda, if we look at the top tier banks, Stanbic, ABSA, and maybe DFCU, the top tier banks in this country, you find Centenary, they are largely concentrating on the government securities, the swaps, and all these other innovations that are a little bit not understandable to Umuntu Wawansi, because they're just trying to understand even just their bank account. And I feel like it's time, now that we are seeing that all this geopolitics is going to affect us, that we would want these banks, all of them, the 25 of them, to kind of engage in businesses to stop the over-reliance on the government securities and then start financing SMEs directly. It's very easy. If you look at all the financials, now it's reporting season. All of them are going to make money, but the largest amount of money is coming out of the government securities, which is very nice because at the end of the day, David wants to defend his bottom line. But the thing is that the person who is operating a shop downtown really needs support. The SME businesses, we have seen that the manufacturing is now past the 10%. Can we come and partner with these manufacturers? As in, why should we, the PST talked about venture capitalists. Why should we be imagining them out of the blue, trying to find them in America and everything? And yes, we have ABSA here, Africanacity. I watch all your ads. I'm a favorite for them. But the thing is that I want to see that Africanacity in our local companies. Ugandans really have the potential, but they just need that support. As for IBRA, I know that NSSF wanted to start, and I know it's a restriction of the law, is that they wanted to now also be venture capitalists to kind of find already these manufacturing companies that have already set up, bring in technical help, and bring in the money. Now, if ABSA and NSSF come in without us looking at America, but we have our money here that has been raised and collected here, and we come and give these businesses money, surely wouldn't there be change? For me, I think I would love innovativeness in regards to that. Then maybe to Mr. Sajabi, we have, me personally, I am in the capital markets. We have had talks. I've attended all workshops in regards to government securities to the Muntu Wawansi using the mobile phone. I think even they brought some Kenyan company. But can we have a timeline? Honestly, I'm tired of giving feedback on those meetings. I am tired. Even last year I was on a Zoom call and I stated the same thing to Ministry of Finance. It is high time we start working because the working groups are there. The central bank governor said that, you know what? The technical team has to come in. Let us stop these high-level things and really get down to the business of calculating and seeing how we are going to really bring it to the forefront. I personally, with our company, we have traded for locals and circles over 20 billion in government securities. And we are being watched by the what? By the central bank on how we are doing it. And it's also through the partnership with the Uganda Securities Exchange. Can we make that grow? For my sister here, Miriam, heads up, I really love her, she's a mentor. Let me tell you something. I do not know what the plan is, the government interruption with our listed companies. NSSF is one of the largest shareholder for one which is currently facing all battering in what? In the local dailies. We had a good trading counter on Umeme. But clearly also the investors are scared at how much political will is in this country. That the politics in this country can destabilize all of us. The reason why we're not having that counter trade, yet it's performing, its regulator has come out to defend it. The regulator is the best performing, and even itself it's the best performing in Africa as of last year's awards. But then the thing is that the politics keep coming and crushing it. And guess what? In as much as we want venture capitalists and all these people are not going to come because the government has a lot of power in these concessionary what? Agreements. They're not even actually following performance. I don't know whose criteria they are following. But they are not following performance, because if it was performance, I don't think even concession should be a discussion right now, isn't it? Thank you.
Okay, thank you, Susan. Now I've remembered. That is Susan from Crested, right? Okay, very aggressive lady. Put your hands together for her. And she has asked everybody a question. So can we take some other questions? Everybody has a question from Susan. You will respond to that. Can we have some more questions? But please, pick a panelist and ask one question. Susan, because you are fast, you got away with that. But the next panel, members asking questions, keep it short.
Hello, my name is Ruth Adong. I work with the K Financial and Sanyo Them. My question goes to Miriam. And my question is, how convenient are the current procedures to support companies issue corporate bonds?
Great. You get an A+. Let's have some more questions. Today the ladies are killing it. There's another lady here.
Hi, good morning. My name is Patricia. I have a question about the ability for us to withstand any ongoing financial shocks, or rather supply shocks based on what's happening in Ukraine and Russia. I know the permanent secretary mentioned that the price inflation at the moment is temporary, but we all know that, you know, war is unpredictable and nobody knows exactly how long it could go on for. So I would like to know what strategies or policies the ministry has in place or is considering to help the country withstand those shocks. And my second question is about the sustainability question. For our agriculture sector, are there any policies in place to finance the transition of our commercial farming sector towards more sustainable farming practices that could help them withstand the climate change that we're seeing going on and in the long term? Thank you.
Thank you very much. We didn't get your name.
Patricia.
Patricia from?
Altex, East Africa.
Oh, from Altex. Okay. Thank you very much. Let's take a few more questions.
Thanks, Helen. Thanks, Sam. My question is to Jeff. I want your view on debt sustainability, because there's been a lot of debate about the 50% debt to GDP. Now, when I see Uganda has appreciated 2.1% on your graph, on one of the graphs you presented, I noted that Ghana, on the other hand, is maybe 18% depreciated, and then its debt to GDP sustainability seems to be a big problem. What are your thoughts about scenarios like that? Secondly, I don't know whether Sami could allow me. My question goes to Miriam. We noted that the previous IPOs, there was a lot of interest on a Stanbic IPO at the time. What do you think would have happened to MTN? Is it possible that the regulator could have maybe close an eye, and the IPO issue has got away with a lot of juice in the mix.
Only that you didn't introduce yourself.
My apologies. My name is Dr. Dan Twebaze. I am the leader for the trade group. We do real estate business. And thank you very much, Mr. Sam.
Dan, you're most welcome. Thank you.
Good morning. My name is Stephen Keijuka. I work for Financial Markets Department of the Bank of Uganda. My question goes to the Chief Economist and Mr. David Wandera of ABSA. Indeed, thank you very much for the report. My question goes towards the exchange rate, shilling forecast. I think I hold an alternate view in terms of you are forecasting a depreciation over the next 1 or 2 years, whereas in my own view, we're seeing lots of dollar inflows, we're seeing lots of FDI, we're seeing preparation for first oil, as you may say. And I know that shilling currency forecasting is akin to a fool's errand at most times. However, don't you think that we should be looking at an appreciating shilling in the short to medium term, given strong dollar inflows have been coming in, as indicated by our Deputy Governor earlier, and general outlook on preparation for first oil? Thank you very much.
There's one behind you there, Helen. We'll take 2 more. I think Mr. Kaijuka is talking about the possibility of a Dutch disease, right?
Good day, everybody. My name is Alex, and I work with Startup Africa. So my question is for David. We are in the sector of startup acceleration and entrepreneurship education. And we get the sense that a lot of entrepreneurs and innovators are waiting for funding, waiting for money. So you've got 2 groups. The ones have brilliant ideas and get stuck because there's no money coming. And we got the other group is just, yeah, I have to wait because someone have to give me money and then I can do something. That's a huge problem, but because both groups are getting in one group. And it's very hard to decide who really needs the money and who don't really needs the money. So my question is, David, you as a banker, how would you think this could be targeted? This big point of understanding the target group as well. Thank you very much.
Thank you very much. There's a gentleman at the back there. Then we will have the panelists respond, and then we'll have 1 more round of questions, and then we'll summarize.
Yes, morning. My name is Ali Toha, and I work with New Vision. Just quick one to Miriam. Yes, we had the MTN listing, but yes, a lot of things happened. Most funds didn't go in as big. Airtel indicated that they'll be on the market before the end of this year. I just wanted to understand what lessons did you pick? We had lots of quasi-analysts bringing up stats that don't make sense. People didn't really buy. So I wanted to get it from you. What lessons did you learn from that IPO? And we don't want to see all that bad energy come into another listing. Thank you.
Okay, thank you for those questions. So we'll start with Jeff, and we'll move towards this direction. Answer the questions that were put to you.
So I think there were 2 of them. One is around the exchange rate forecast, and I think there is always more art to this than science. But the 3 points that were made, I think, were very relevant. So one was around FDI and all of the investment that will come in around first oil. And I think that makes absolute sense. The challenge in that side is that almost all of the FDI money is then spent on imports. So it's imported engineers, it's imported construction, it's all of the cement, it's all of the steel, it's all the materials. So when we think about the flows for the currency, There's foreign investment coming in, but almost all of that investment immediately is used to spend on stuff that's imported. So it tends not to provide, if you just think about demand for dollars, it certainly changes the medium and long-term outlook for the balance of payments, but in the near term it tends to be offsetting. There was the question around the dollar inflows. So absolutely, and I'm sure my colleague from Markets, David, would support this. Absolutely, we've gone through a period where Uganda, from global institutional investors, people who manage money on behalf of others, Uganda has been seen as a very favorable case. So willing to bring euros and dollars and yen and bring them here to buy government securities. Very supportive for the exchange rate. I suppose in our forecast, we're imagining that that environment is going to be less helpful going forward. The global environment we think is going to be more risk adverse. We think as the US raises interest rates, some of the money that might find its way into Africa is likely to find itself back into the US. But it's contested terrain and it's not specific to Uganda. If we were to look at our forecasts for the Kenyan shilling, or if we were to look at Tanzania, you would see similar sorts of weakness. And then I think the next bit, and I think it's important, right now, oil price rising is a real challenge for anyone who imports this stuff, right? So at current prices, let's imagine it's somewhere between $500 million and $600 or $700 million that Uganda will need to pay for the same amount of oil it was going to have anyway. So if we think that the exchange rate is really about supply and demand for the currency, well, that's a whole bunch more dollars that need to be bought, right? And so that's a whole bunch more dollar demand and a whole bunch of shilling offer. So I think all of those things support the view that the currency, to our mind, is more likely to go weaker than stronger. But your opening comment, that it's a bit of a mug's game, I think that that's it as well. It's a contested terrain for sure. But then the question around debt and debt sustainability, it's sort of a curious environment, right? If I believe that you are highly likely to pay me back, I'm going to give you a better interest rate. That you get a better interest rate makes it easier for you to pay me back, and this whole thing creates a virtuous circle. At the same time, if I think you're less likely to pay me back, I charge you more, it makes it harder for you to, and away you go. And so debt sustainability is often much less about the amount of debt you have. You mentioned 50% of GDP. I haven't helped the case because I used that on my graphs. But there's nothing magic about 50% of GDP. Earlier we heard the example of Japan. Almost 200% of GDP, but the interest rate that Japan pays on that is basically zero. Now, if you were offered a bond for your house at the interest rate of zero, and you were to ask how big a house you should buy, I don't know, bigger, right? Whatever you're thinking, it should just be bigger. And countries are like the same. So we have countries here on the continent like Nigeria, doesn't actually have that much debt, but has no government revenues, hardly. They spend 80% of their revenues just paying interest. That doesn't feel terribly sustainable to me, all right? Country might have much more debt. Japan spends very little of its revenues to service the debt, looks quite sustainable. So the interplay here is very, very complicated. And so what you want to do is make sure that as a country you stay in that place where people feel you're more likely to pay back, so the interest rate they charge is less. And so when you think about what you use the tax collected on, you spend less of that on servicing debt and more of it building roads and rail, building hospitals and schools, and providing for the economy. So I don't think there's any specific one answer in that space. But countries that are seen as better credits pay less, which oddly enough makes them better credits. It's a bit circular. But let me finish my comments there, please.
Thank you very much, Jeff. Miriam, you had a lot of questions there. I told you you're going to raise so much fire. Okay, now deal with the fire.
All right. So thank you, Susan. With regard to private equity funds, The CMA is looking at our legislation to see whether we can register private equity funds, not just venture capital funds. And that's something that we are looking at doing this year within the existing framework. When that is done, of course, it's going to be very helpful in terms of promotion of private equity. That said, there's need for more collaboration between regulators of institutional investors, like the Uganda Retirement Benefits Authority, the insurance regulator, to look at the investment limits in some of these private equity funds. So that's very important. So we'll be looking at that. In terms of political interference, I'll take that as feedback. I will not make a public comment on that. Ruth Odong, thank you for your question on procedures to support companies issuing corporate bonds. The CMA law was amended in 2016. And one of the key amendments to that law was to facilitate the raising of capital and to allow the authority, when it comes to raising of capital, to give a waiver, a justifiable waiver, with regard to any requirements in the law. Now, that was to make it easier for companies to raise capital and for companies not to feel constrained by the framework. Unfortunately, very few companies have taken advantage of that. So that's a very key amendment, and there should be no excuse from any company issuing debt or equity, because we will work with you to facilitate that process. One of the other amendments that was done in regard to corporate bonds was to introduce a trustee for bondholders. When it comes to corporate bonds, things like use of proceeds. Sometimes people raise money from the public, they say they are going to do A, B, C, and D, and they do none of it. But now a trustee was introduced for bondholders to make sure that they hold the company accountable that has issued the corporate bond. So that's also a very good intervention. Lastly, we have the Oath of Securities regulations that are simplifying the process of issuing debt. And these regulations have been passed by the board and are now being drafted by the First Parliamentary Council. So we are going to see the framework become more flexible. The duplication that has been raised in the past is also being erased. Dr. Dan, you ask a very pertinent question with regard to the MTN IPO. And I'll respond to this together with a question from, I believe it was Ali. When it comes to the IPO, what happened with the IPO? Ali analyzed it correctly. Who was giving opinions? Did anyone in this room do a research report? One person. Just one. You did a research report. You went to the prospectus. You analyzed it. And you gave investors information that they could rely on to make an investment decision. One person. Nobody.
You've made them very afraid to answer, but just go on.
Nobody. And that's the challenge that we had. Because the first information that comes out carries the wave. So we have people who they are not analysts. They don't do valuations of companies. And they're the ones telling people what to do at the IPO. Now, we know very well our capital markets is nascent. The amount of investor education is very low. So what do people do? It's herd mentality. If people are saying this is not good stock, people are going to keep away from the stock. That's what happened. And that is what we are going to deal with when it comes to Airtel. I'm imploring you, get the prospectus, look at it, give your opinion. We have CFAs in this room. How many of you came in to give an opinion? None. Chartered financial analyst. You kept quiet. We're not going to keep quiet anymore. So CMA started engaging analysts, but it was a little bit late. And then we had extension of an offer. To extend an offer, there has to be new information under the CMA Act. There was no new information. So all the Ugandans who waited, and then we also had the case against CMA. You remember that in the press? By the time the case was dealt with and people said, we are now ready, the offer had closed. So those are the problems that we have. Let us be vigilant with the Airtel IPO. Let us give our views. These listings are for us. Let us take advantage of them. Whether you're a trustee of a pension fund or you're an analyst, let us be part of it. Now, I think that's all. Stephen, I'm not sure what your question was. I'm not sure if I responded to your question, Stephen.
You'll get back to it. We
Okay.
need to move on.
All right.
Ladies and gentlemen, we are also online, right? There are people listening in online and on YouTube and on all those other channels which constitute social media. So we've got some questions. And David from Bank of Uganda, this one is for you. Given the proposed plan to expand opportunities for investing in treasury securities through fund channels, what are the likely effects on the cost of private sector borrowing, assuming we see an increase in the number of investors? David, you could also note that. Two questions for Ibrahim, and I wondered why they were not coming, but they have now come online. Ibrahim, what is the expected impact on the NSSF of the midterm access that has been approved recently? And the second one, what preparations and guidance has been given to people getting the 20% midterm access from NSSF? Those are two questions for you. Okay, David, you have 3 minutes to answer the questions that were put to you, including this one which has just come in, and then we will move on the opposite side. David, over to you.
Okay, thanks, Samuel. I wanted to ask which David, but you clarified. Just a few questions that I think my side. I'll start with the issue of private sector lending. Lending interest rates in Uganda have remained relatively high, and they're really sticky downwards, and they do not respond to our signals as a central bank. They do not respond as well as we would have wished them to. As you know, to support the economy during the COVID pandemic, the central bank lowered the CBR to an all-time low of 6.5%, and we've maintained it at that since then. But lending rates are still very high. I think in December, they were like 18, these are prime lending rates, 18.6%. And the number of factors for this, some of these are structural factors. The cost of doing business in UG, institutional deficiencies, and the risks involved, and also the resolution of commercial cases on the part of the banks themselves. If I recall very well, as we speak now, I think banks are sitting at about 1 trillion shillings in unresolved cases. In courts, cases just take forever. And so all this increases their risk aversion. And these are part of the reasons why the interest rates tend to be high. And I think, as Jeff mentioned, we then have that problem that if the banks deem a borrower to be risky, then they'll raise the rates, and then it becomes difficult for that person to pay back, and then say it's some kind of vicious circle, unfortunately. But we are taking steps and measures to at least ameliorate that. From our part, as a central bank, is by reducing the CBR, and hopefully with time, then lending rates should be responsive to the policy signals. If I may go to the timeline raised by Susan again on the project Savinga. Yeah, yes, there was a bit of time taken during the preparatory phase of this project. At the time of in 2019, we had a development partner who had committed to fund the project. Unfortunately, because of the effects of the pandemic, they pulled out at the last minute. We must congratulate government that has said to take it on, and in fact, in this year, government committed 400 billion shillings towards this project. So we're on track, but it requires about $1 million now because of and yes, I say congratulate government because even with the revenue shortfalls that we all know all about, they still committed 400, but agreed that because of the fiscal demands, this will be funded over a period of 3 years, putting some money in the budget each year. So we hope that in the next 2 years, we should be ready to go. Effects of the Saving project on private sector borrowing. Yeah, there could be some effect, but we think more because this project is intended to target the omuntu wawansi, if you may. Instead of keeping the shillings under their mattresses, we want to encourage them to put their monies in treasury bills and treasury bonds. We want to make it so easy for them. As I said, minimum amount is 100,000 shillings, and we want to make it easy for them to buy in and get out. So that is the main target. As you know, even as we speak, there's a lot of money in the float of mobile money. That's not earning any returns. So that could also be tapped into for the benefit of both the savers, but also for government in terms of access to funds to finance the budget. Chair, there was a question on supply shocks and disruptions. Yes, unfortunately, we are not immune. So I think we're facing the effects of the geopolitics on our economy. Oil prices, in particular, are going to hit us. The price, I think, this morning is probably heading towards $140 per barrel. So the prices of fuel will certainly go up, and that will have, as we know, that has a ripple effect in terms of the prices of a number of other commodities as well, which have to be transported. So that unfortunately will hit us, but we do hope that this will be short-lived. I think the general view is that some countries like Saudi Arabia will be able to ramp up production in the short run and at least overcome the supply side constraints that may be faced by this geopolitics. Thank you, Chair. I think those were the questions that I
Okay, thank you, David. Unfortunately, we are beginning to run out of time, so we may not be able to ask more questions. So I'm going to ask Ibrahim. First, David Wandera, you had questions. So please respond to those questions. And then lastly, Ibrahim.
Thank
Ibrahim,
you.
Everybody looks at you every day with envy.
Thank you, Chairman. There were a couple of questions around what we as banks can do to provide money to Umuntu Awansi. I just want to say that we are in a fortunate and unfortunate position as banks in that we are an intermediary. So the money that we lend belongs to somebody. It belongs to you and me and other people. So we have to be cautious. Right now, I'll say, as ABSA and from the Startup Fund, it's good that you're here because there is a bridge between those people who might be lacking in records and formality. I like what the PSST said. We need to move away from informality. The general Muntu Awansi is informal. He doesn't have bank records. He doesn't have accounts and things like that. And that is where the challenge is. Because if I came to you and I said, lend me money, give me your money, and I cannot prove to you that I cannot pay it, what would you do? So right now, what we as banks are doing are trying to upskill SMEs and all the small Muntu Awansi person to try and get you to formalize your business, to try and get you to run a sustainable business with good governance. Last month, for example, ABSA, in partnership with GIZ, educated about 60 60 SMEs graduated, 60 SMEs from our academy, and the aim of that academy is to basically get people away from informality to formality. If you come to the bank and the bank is asking for 1 year of bank statements or 2 or 3 years of bank statements, you've been in operation for 5 years, but you've been operating under your pillow. So you cannot prove that you're able to repay. And like David Ajabi just mentioned, there are huge cases in court right now, non-performing loans and things like that. And the bank is in a position where we need to be prudent in managing the funds that we lend out by making sure they can come back. And how do we do that? By making sure there are good governance processes. Otherwise, you will not put your money with the bank and the bank will not be able to lend money out. So that's one of the things we're doing. But for those that are able to have records, there's unsecured lending facilities. You know, specifically in ABSA, we have up to 100 million unsecured. For other companies, up to 250 million unsecured, meaning that you do not need to have collateral to come and take that money. Yeah, but there are obviously conditions on the back of that. But the key is moving away from informality. The more we can move away from informality, then the easier it is for the banks to support you in growing your businesses. Thank you.
Thank you, David. Ibrahim, you will have the last word, and then we will summarize and hand over to the Master of Ceremonies. So, Helen, I hope you're ready to invite the chairperson to close.
Thank you so much. I'll respond to the first one, the first comment from Susan. Yes, actually the NSF has a program in place to fund startup companies. I think about last month we gave out over 500 million. It's the starting. We've partnered with some banks and also MasterCard to try and do this. But ideally, in most markets, it's not a space for pension funds. Yeah, those you could be aware that we don't really tend to participate at nascent levels. Nevertheless, we are aware that in Uganda we expect to participate at all levels, but that's not really our space. There tends to be specialists for that. On the likely impact of midterm on the fund is that now I think we've had time to prepare for the midterm, and also the law, as you may be aware, was a bit changed. The first one was 45 or 10 years. That meant a massive outflow in a very short space. This sort of brought in what we call an intersection, 10 and 45, 10 years of saving and 45, and somehow tightened how much money is likely to go out. If you've been following the press, we expect to pay out about maybe near 800 billion by June of this year. We are set. We've been preparing for this. We have the money to pay the members their money. So we don't see anything like NSF engaging in asset sales or NSSF being very fiercely out, so totally taken out of the market in terms of investing. We prepared ourselves, and we think the fund will be able to go through this. Nevertheless, it changes how we invest money going forward, because we've been paying out benefits which were about less than 5% of all our assets. Yeah, the ratio of benefits paid out divided by the total asset base has been about 5%. That ratio is going to go up. And therefore, the fund seems to be maturing faster than it should have matured under all circumstances. That has implications on what sort of risk we take going forward, some of the ideas you're mentioning, because whenever NSF is put in place, we should think about the member before the social causes, because the member comes first. Safety of members' savings with NSSF, as well as the return paid to the member, before we look into other social causes. So I think we are good. On the next one, what have we done? They mentioned the financial literacy programs. I like to think the NSF one is the most popular one because it seems to go to everyone. We have a very huge financial literacy program that tends to cover everywhere. We are more popular on all social media platforms. We invite our members and talk to them. We built in place a mechanism whereby a member comes to us and we try to talk to them before they take their money. But to us, we also see this midterm as a preparation for the members before retirement. Yeah? Members have been taking their money, and when we research afterwards, they've not perhaps been able to use this money well. Now, if you take the 20% and somehow you overestimated your ability to sort of manage this money and you see it didn't work out, maybe the next 10 years before retirement, you will prepare better. So it's a training ground for the members themselves. It's an internship kind of thing for the members themselves. and we think it's a good thing for the country in that sort of space. Thank you so much.
Okay, thank you very much. I am going to summarize what I have taken from the panel. Since I am the chairman, you have no right of reply, members of the panel. This is what the panelists have said to you. One, we are moving in the right direction. I think the biggest takeaway here is that an economy is a very large ship and it moves very slowly. But we are moving in the right direction, but slowly. I think that's what Susan was telling you. Point number two, which has come out without being addressed very directly, is there are concerns with property rights, because property rights are critical for the resolution of disputes in business. These need to be improved. David Sajabi, I didn't want to put you on the rope, but I had in mind the recent Supreme Court ruling, which had our hairs stand on end. And we are really concerned about the capacity of the regulator being impaired by that ruling. But we'll leave that for another day. Very sensitive matter. Three, I think this goes to you again, David and Miriam. The bureaucratic delays, again mentioned by Susan, need to be addressed to improve the investment climate and the alternative offerings that are available in the market. I think that also has to go with more investor education. Four, I think this was first mooted by the PSST. We need to have a reduction of informality, and this will improve the capacity of our local investors and the market depth. So I think this is a very important issue that we need to address. But I think this is a very difficult issue from the point of view of saying that, look, I think the PSST is not here, but he likes using this, this point that when we liberalized, not only did we remove the door, we also removed the windows and threw them out. And there's a problem there in terms of achieving a balance, because what has really happened is that the informality that has been created has led us to saying people should become entrepreneurs. The truth is, not all people can be entrepreneurs. So we need to create large investment schemes, large factories, large corporates. We have been fighting in the Sudan, in the Congo, and when we leave to stop the fighting, the Kenyans enter those markets. Where are our captains of industry? And I think that is a very big problem associated with this informality. Lastly, there need to be initiatives to improve local investor capacity. These are important, and that will help improve our score on that pillar which Jeff gave us. So I thank you very much. You have been a good audience, and the questions were very useful. Since Women's Day was just yesterday, I could see the ladies took the lead. Thank you so much, Ruth, Patricia, and Susan. Thank you so much. Over to you, Helen, and thank you, members of the panel. Thank you, ABSA, for having let me do this for you. Thank you.
Thank you very much, Dr. Sejaka. Another round of applause for Doctor and the panel. To close, please allow me invite Mr. Alex Rugamba. He's one of our non-executive directors, and he's going to be representing our chair and the rest of the board.
Thank you very much, Helen. Mine is a very simple task. I'm here on behalf of Mrs. Nadine Biarugaba, who is the board chair, and that is really to move some votes of thanks. The first one I would like to move is to the Deputy Governor, and David Sajabi, please convey the gratitude of the board and management of the bank to the Deputy Governor, Dr. Michael Atingego, for a very brilliant keynote address. I think he set the scene very well for our discussion today. Also thanks to, of course, the PS and Secretary to the Treasury. He's not with us here, but these thanks will reach him, no doubt, for his very pertinent remarks. Again, building on the keynote address. Next, I would like to thank the team that made the presentation. Jeff and David, thanks for your report. I think my key takeaway is that things are moving for Uganda, moving well. Rising up 5 places is no mean achievement. I think we should definitely pat ourselves on the back as a country that this is a very good progress. There will be a lot of interest in next year's report, I can assure you, from listening today. So let's hope, and Deputy Governor said it, that we should aspire to move even higher. So yes, we are at 5th position, but why not 1 or 2 notches above? Let's wait. Next year is not very far. We'll be very keenly seeing the progress there. The next thanks, of course, to Professor Sam, who moderated this session, and the very good panel who supported him. I don't want to repeat what he said, but the questions were on point from everyone. Responses too. Thank you very much, the participants, for your very valuable inputs. I think these will help the team who prepared this annual index to really take on board stakeholder considerations. So thank you very much. I think now I'll turn to the management, and led here by the Managing Director, Mumba, and your management team and staff for putting this together. From the board, we always encourage these type of events, and we always say, management, really, this is what you should be doing. There are perceptions that banks are just there to receive money, lend money, and make money. That is not correct. Banks also have a key role to play in terms of knowledge sharing and also thought leadership. And this is what this event is all about. Because unless you have knowledge, unless you know the bigger picture, unless you know where investment opportunities are, it doesn't really help the client. So from that point of view, congratulations, Mumba and your team. Helen, you have done a wonderful job putting this together. I may have missed some people in my thanks, but I think I've covered most of them. And like I said, let's give ourselves, as they say in French, a rendezvous for about this time next year, Jeff, is it? When? Even earlier. Now travel restrictions have, eased, so we'll be happy to see the team come back and make this presentation. So thank you very much, and see you next year.
Thank you very much, Mr. Alex Rugamba. Ladies and gentlemen, I know you're all seated. You're still seated, which shows that you've actually enjoyed the proceedings and you're not even ready to go. Thank you for indulging us and being with us for they've been 4 hours of your time. So we've come to the end of today's session. Have a great day, and we look forward to hosting you again.
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
Hey.
How was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?
Whoever you're doing it for, we'll help you get it done. Simply. That's Africanacity. That's
Shop online, get free swipes, and enjoy greater security with a card that turns banking on its head. That's Africanacity. That's ABSA.
Please make those payments and take dinner out the freezer. Enjoy your day off.
Hey.
How was your day?
Great.
Did you pay the bills?
Abby did it.
And the plumber?
Abby did it.
Send money to your mom?
Abby did it.
Who's Abby?
Abby.
Bank on WhatsApp with Abby, your 24/7 digital personal banker. Another digital innovation that gets things done.
Did you take dinner out the freezer?